Howdy. Welcome back to Dion Talk. Hopefully now the howdy makes a little more sense. The purpose of my content is to help the average individual learn that you can reach financial freedom in 10 years or less, even if you're not starting from the best position. One of the things that trips people up a lot when it comes to financial freedom is taxes. A lot of people focus on retirement accounts, thinking, when I reach retirement age, I want to have money that I didn't pay taxes on or that I paid less taxes on. And I actually have a couple of videos on my channel where I talk about the main reasons I don't like retirement accounts. An example is, even if you have a retirement account where you put money in and it's not taxed, when you take the money out, that is then earned income, which is pretty much the highest taxed income that you can have. And you're also hoping that in the future, taxes are less. Have you met government? I don't think taxes are going to be less. You're also hoping that you retire in a lower tax bracket, which means you're hoping to retire broke. Not the best form of hopium to live on. So for me, when it comes to tax benefits, I like real estate. And the live streams, this is going to be a nice short one. It's probably only going to last a little bit. So I'm going to talk for a minute about how taxes impact my investing decisions. And that'll give people a chance to put some questions in the comments. And then the live stream will last as long as the questions keep coming in. Sometimes people will say, I want to buy an investment because of the tax benefits. And to me, that's a mistake. When you make an investment, you want to take advantage of the tax benefits, but you don't want to make a decision to get the tax break. Like saying, I want to have a mortgage so I'm paying interest so that I have interest as a write-off in my taxes. You're going to pay more in interest than you would receive back on your tax deduction. So that's not a reason to get a mortgage to have interest as a deduction on your tax returns. But if you have a mortgage, you definitely want to take advantage of having interest as a write-off on your tax returns. Do you see the difference? We don't want to let the tax tail wag the dog. I've heard that sentence several times. Never understood it until probably the last 10 years or so. One of my favorite questions that comes up a lot when it comes to taxes, especially in the BiggerPockets forums or in the Facebook groups like Real Estate Rookie or the official BiggerPockets Facebook group. I need to get my LLC set up so I can take advantage of the tax benefits. And while I am not making an LLC video on whether you should have one or you shouldn't have one yet, because it's going to be a rant, there are times where it makes sense to have an LLC. If you have partners, it protects you from someone else's mistakes. If you need commercial lending or hard money, lenders are going to usually require that you have an LLC, so it makes sense. There are times it makes sense. Tax benefits and asset protection are not reasons to have an LLC. There are absolutely no tax benefits to having an LLC. The IRS actually calls LLCs a disregarded entity, so it has no impact. There are other things you can look at for tax benefits, like having a trust, generally to protect your heirs more so than yourself. And there are some things that if you're running other things in addition to your rentals, like property management, if you were managing somebody else's property, where your tax professional will let you know if you want to have an LLC or not, or an S Corp or a C Corp, or which one fits your specific situation. I have a couple of LLCs. I run a truck driving school that's in an LLC. I have a nonprofit that's in an LLC. My rentals are not in an LLC because of all of the problems that creates. So we've got that out of the way. We're not going to get an LLC for tax benefits because there are none. We get to take the same write-offs as a sole proprietor as we would with an LLC because it's a pass-through income. Generally, rental income is taxed as earned income. So it's scaled. If you have a W-2 and you make a certain amount, it's taxed as you make more. That higher bracket is taxed more. And the IRS has it literally spelt out. The more money you make, the higher the percentage goes. And then some states have an income tax. So your rental income will generally fall into that same category. There are some things that are a bit different. If you have a W-2 job and you make $100,000, the IRS is going to take out the amount of tax that you owe based on the brackets that it took to get up to $100,000. If you have $100,000 of income from rental properties, you get to pay your expenses and then be taxed on what's left. And this is just on the write-offs portion. There's actually depreciation, which we're going to cover tonight too. But you get to write off things that you were probably saying in some cases going to do anyway. If you have a property manager to manage your rentals, that is a tax deduction. That expense comes off of the money that you brought in from rents before you pay your taxes. If you have yard care service, if you, depending on the type of rental you're doing, if you're doing short-term and you provide Wi-Fi, that expense is a write-off. The big difference between earned income from a job and income from rental properties is the way the money flows. The government takes the taxes and gives you your paycheck. I mean, your employer holds the taxes to send it to the government. At the end of the year, you file your taxes to know if you hit their mark or not. It's one of those really cool times where you have to do the math to figure out what you owe. And if you get it wrong, you risk jail. With rentals, you get the rental income, you have expenses, and then you're taxed on what's left. So there's a lot of reasons why rental income is more attractive than W-2. Not just the fact that W-2 income comes in by selling your life 1 hour at a time, and rental income comes in because you purchased an asset. I'm not saying it's passive. You're either managing tenants or you're managing your property manager. So there is some activity involved in rental income. But the tax benefits are amazing. With the tax structure, so in 2021, I'm doing my taxes this year. It's kind of the purpose of the reason of this video being titled Taxes and Rentals, and you being squished in the middle. I had a 6-figure income with my W-2 job. I run a truck driving school. When I first started, I was an instructor making $17 an hour. That was what we topped out at. Now I'm a part owner. I own 10% of the company, so I'm making a bit more money. I also had 6 figures in rental profit. I'm very transparent when it comes to my income from rental properties. $128,000 in profit on rental properties, 16 units. With my W-2, I am paying, and the technical term is an F-ton in taxes. And don't think of taxes at the end of the year when you file your taxes. Do you owe $200? Did you get back $1,000? Did you owe $1,000? Look at the actual number that you paid. The goal is to kind of owe nothing and receive nothing, because then we paid the right amount throughout the year. If people think, I got a tax return, it's like free money. From your W-2 income, not so much. If it's from child tax credit, earned income credit, and you're getting more money back than you actually put in the entire year, sure, you're making money there. With my rental profit, $128,000, $0 paid in income tax. 10 years of rental properties, 11. First one doesn't really count because it sucked, but 10 years of actually productive rental income. I've never paid a penny in income tax on rental income, even though technically it's earned income and taxed the same way W-2 is when it comes to the amounts. We get to do things like take a write-off. So HOA fees. I have 2 properties. I found out, not just one, that are in an HOA. I prefer to never buy in an HOA, but somehow one snuck by, and I purchased a house in an HOA before I was an investor. There are a long list of reasons why I'm never going to own in an HOA again. That's a good thing for a video. I should take a note. Maybe that's a good thing to bring up with Three Amigos on Thursdays with Michael Zuber and Matt the Lumberjack Landlord. Nightmare problems of having an HOA, and how actually having a rental property in an HOA will make your, not inflation. I hate it when my brain turns off. Appreciation. The appreciation of a property is lower in an HOA. And so many people say, I want my property in an HOA because then the neighbors are going to keep it up, so my place will appreciate more. Well, when 80% of the investors out there avoid HOAs at all costs, you've greatly diminished the amount of demand on that asset, so appreciation is less. Don't need to make a video, just got to cut that section out. So you get to write off all of these things and lower on the rental side, you get to lower the amount that you are going to be obligated to pay taxes on. And everything I'm going to mention today, I rarely actually say this. I hear this on a lot of other channels, but this is not actually advice, not financial advice. This is for entertainment value, because I'm actually going to talk specifics on taxes. So don't sue me, bro. There is a big difference between tax evasion, like if you've ever bought a car and you paid $2,000 for it, but you write the receipt up for $500 and you go to the Department of Licensing and you register the car in your name and you say you paid $500 so that you pay less tax. That is tax evasion and could end you up in jail. Prison, to me, it's kind of like the ultimate house hack. Free food, free medical, all the sex you don't want. It's kind of like high school, and good retirement plan. I don't want to go there, though. So we're not going to use tax evasion. We're going to do tax avoidance, legal tax avoidance. When people hear things like, and I don't care if you like him or you hate him, President Trump had 5 years where he had 3 years where he paid no taxes, and then 2 years where he paid like $700 and something. And I heard Ken McElroy say this. That means that Donald Trump's CPA should have been fired. And not because he had 3 years where he paid zero taxes. It's because how could a guy that has that much debt owe money in taxes? The whole point of investing in real estate is, one of the benefits is the legal avoidance of taxes. So with me investing for 10 years, having 6 figures of profit in rental income, I'm paying $0 in rental income tax. Well, my CPA has it to where I'm doing that. This is actual advice because it's not about financial, it's about life advice. The second you own a rental property, you hire a tax professional. It could be an accountant or a CPA. I use a CPA. Originally, the first few years cost $600 to $700. Now it's around $1,500. As your portfolio grows and the amount of things they need to do, the amount of purchases you make, the amount of paperwork you create for them, their cost goes up a little. That $1,000 to $1,500 a year is saving me tens of thousands of dollars. Absolutely worth it. When I learned that there are different types of depreciation, not only do I probably not have the capacity, but I don't have the mental bandwidth to commit the time that it takes to learn what the different depreciations are, when they're usable, when it makes the most sense to use them. So hire a tax pro. You get to write it off. The expense is a write-off. You're still going to pay more than you benefit from the write-off, but since you're going to have the expense, you want to benefit from the write-off. You don't have the expense to get the write-off. So hire a tax professional to do your taxes because you want to make sure that they know what write-offs are legal, which ones are in a gray area, which ones to avoid. There's a lot more to understanding tax write-offs, especially when you use something like house hacking. If you're house hacking a small multifamily, are all of the write-offs on that structure, everything all of the expenses a write-off? If you're occupying half a duplex or 1/3 of a triplex or 1/4 of a fourplex, things I don't need to know. I tell the CPA which one is my residence, which ones are rentals, which units are rentals, where the expenses were assigned to. They determine whether they're an actual write-off or if it's on my own personal space. And the write-offs generally won't get you to zero. You want to bring your earned income on your rental profit down to zero as far as the IRS goes whenever possible. It's actually very easy, especially in the first 5, maybe 10 years, to show a huge loss every year. And you're able to carry losses from one year to the next. But you might not want to do that because you want to be lendable. And if a bank sees that all you have is losses, you might not get qualified for the next mortgage. So there's a way when you're talking to your CPA to specifically say, I want to be bankable. So I don't want to show too much of a loss. It doesn't usually make much sense not to take advantage of depreciation. Whenever you go to sell, the IRS is going to assume that you used all depreciation available. So it doesn't really benefit you not to take use of your depreciation. But we can choose which write-offs we use. Just because we buy something for a rental doesn't mean we have to say that is an expense and I want to use it as a tax write-off. You're in control of that. And that's why I make sure the CPA knows that as we're going through my write-offs and my depreciation schedule, I don't want to show too much of a loss. So we're covering the write-offs. Your CPA will know what is a write-off. There are things that you can write off when you are running a business: internet, your cell phone, how many miles you put on your car, If you purchased a car specifically just for your rentals, that car could be a write-off. Check with your CPA or your tax professional based on your situation. If you have one rental and it might not require an entire car just to manage that one rental, probably not going to get that as a write-off. But how many miles did you drive associated with that rental? And that could be to get parts, to do tours of the property. Your CPA will know what is applicable, and what is not. Another reason why you want a tax pro is because I'm wanting to spend the time and energy it takes to find the next deal, to understand the area average rents, to know how to calculate yield, to be buying the next property. Taxes, to me, are an afterthought when it comes to the minutia, the nuances of it. It's not an afterthought when I'm looking at buying rentals. Why am I buying a rental? There are other investing things. I can start and grow a business. I can invest in stocks. I can invest in crypto. I can invest in real estate. I have choices. Taxes are one of the top few reasons why I chose real estate as my investing strategy. There's a few other ones. I can't house hack stocks. I've asked. Jeff won't let me stay in an Amazon terminal. So I can house hack in real estate. You get the tax benefits. It's easier to build cash flow now. I have more control. There's like a long list of reasons why rentals are the way I chose. So we let the tax professional determine what is a write-off and what is not a write-off as far as your expenses go. Then, and there's things you might not think about. I took a couple notes. HOA, condo fees. If you're covering utilities, or if you're paying for pest control, those are write-offs associated with a rental. If you pay an attorney, and I had my tax pro explain it to me this time, I retain an attorney, giving them somewhere, but one time it was $1,000, one time it was $15. Basically, that attorney now works for you for when you need them, kind of in your pocket, so that when you need an eviction, you're going to use that money to cover the cost of the eviction. The write-off happens when you pay the attorney, not when you have an eviction. So the tax pro will know which year that expense actually goes to. So legal fees are a tax deduction. But it kind of balances out if you have a legal case where you do an eviction and you actually also get to bill for legal fees with the person that was evicted, and you collect that money, that then goes as taxable income. Again, your tax pro is going to know all of those things. I don't need to learn those things. I need to know, why am I buying the next rental property? I could write off a bunch of the expenses, but I have those expenses. So that's not even really a benefit. It's, since I have the expenses, I want to take the tax benefit. I do not want to have expenses to get a tax benefit. Hopefully I'm making sense. You're not going to get a mortgage to have interest so that you can get a tax write-off. But if you have an interest payment, you're going to make sure you get the tax write-off. So the write-offs aren't the reason why I want to invest in real estate. The main reason I want to invest in real estate is because Congress has hundreds of people that were voted into office, and the vast majority of them, they might not enter office this way, but they leave office as millionaires. And almost all of them own property. So what are the odds that rules and laws that they make while in office benefit people who own properties? One of those benefits is depreciation. I've mentioned it a couple of times. We know that appreciation is when something goes up in value. Inflation is when things cost more because the dollar's weaker. But depreciation doesn't mean something has lost value. There might be a Webster's dictionary term out there that explains depreciation as something losing value. But in real estate, even as your property appreciates in value, it's worth more money. You could sell it for a profit. The rents increase. You can collect more rent. Your cash flow might increase because the mortgage, for the most part, stays the same. Principal and interest do. Taxes and insurance go up a little bit, but not by the amount that rent usually does. So you're making more money. You get to tell the government, my buildings are a year older, so they've lost value. And you get to take that loss against your earned income from rental properties. There's a very convoluted math equation that somebody much smarter than me can explain why they chose this number. I've heard two numbers for commercial. I've heard 33 years for commercial or 39 years for commercial. I'm not sure which one is right. I couldn't find an accurate source. But 27.5 years. If you bought a property for $275,000, you would get to write off. Divide that by 27. It's pretty simple. Divide the property value of the buildings, not the land. You have to subtract out the value of the land because the land, technically it's a year older, but it hasn't lost the value that the buildings has. So we get to take that loss against our income. So if you take the write-offs and the depreciation, the rental profit, especially in those first few years, it's very easy for the first 5 to 10 years to show profit that you have no tax obligation on. Much later in our investing, when the amortization schedule of the interest and principal has crisscrossed and we're paying more down to the principal and less into the interest and you have less of a write-off, or you've possibly hit that 27.5 years and no longer have depreciation left, you might owe some taxes. But your cash flow is exponentially larger at that point because, like I said, mortgages for the most part stay the same. Rents keep going up. My first year calculations when I buy a rental property, I'm usually averaging around 10% cash on cash return. I've owned some of my properties for a couple of years, some for 6 or 7, but I'm averaging over a 20% cash on cash return now for my properties because the mortgages pretty much stay the same, refinanced a couple for a lower payment, and rents keep going up. Especially in the last couple of years, rents have kind of skyrocketed. I'm still not paying taxes on rental income because of depreciation and write-offs. There are a few things with depreciation that you have to pay attention to. Depreciation is a delay of taxes. It doesn't waive it forever. It doesn't disregard it, doesn't get rid of it. Sorry, my microphone is like a mile away. Hopefully that's better. When you sell a property, you're going to have this experience called depreciation recapture, where you need to pay the taxes on the gains from that depreciation. You can delay this by using a 1031. A 1031 exchange takes the capital gains that you're going to get when you sell a property and puts those gains in the property that you're buying. So it has to be a like asset for a like asset. So you can't sell a property and buy stocks. Never done it, but you can't sell stocks and buy a property. It has to be like asset for like asset. And a 1031 has to happen with a capital gains transfer. There are some things to think about when it comes to things like wholesaling, flipping, and selling a property for capital gains. Wholesaling and flipping generally happen in less than a year. When you own an asset for less than a year, that is not capital gains. So you can't 1031 those gains because a 1031 is only delaying capital gains. So when you do wholesaling or flipping, you are going to have earned income credit, earned income tax on your income, where you get to use write-offs, but you're not going to experience the depreciation because you haven't had it for a year. If you have a flip for longer than a year, and it has never had renters in it, this is why you want to ask a tax professional what is the best course for you. That is still a flip. If you're buying another property, it's a rental that you're buying. That property is going to become an asset that you use as a rental. The one you're selling has to have also been a rental. So you have to have rental income, even if you have it for a year and a half. If you never rented it, that is a flip. That's the words that my CPA used when talking to me. So verify in your area that it works the same. Because again, not a tax pro. I'm giving you an investor's perspective on taxes. Why do I choose real estate? What are the things I look to do? And what are the things I try to avoid? I'm not giving you a CPA's advice on taxes or a CPA's knowledge. A couple of weeks ago, during a live stream, insurance came up. And I really just tried to explain as an investor, here's what my insurances cost. Here's why I have umbrella insurance. When I live in a property, I also have to pay insurance on personal items. So my insurance costs more when I live there. When I move out, I call and I say, now that's a rental, and my insurance went down. And I got about 10, it's like 8 emails from insurance people who work in the industry saying, you got this term wrong and you said this thing wrong. And when you move out, insurance doesn't really cost less. It costs more because it's a rental, but you're not insuring your personal things. So only your bill went down. And I'm saying, like, I'm the investor. My bill went down. That's what I was saying. I wasn't trying to say how the industry works. So I'm not trying to say how taxes work. I'm saying, as an investor, here's why I use a CPA. Here's why I chose rentals here's why I do certain things, because I know that I'll be able to get a tax benefit from it and make decisions like, do I buy this expensive item in December when I've had a really good year and I need the write-off, or do I delay it till January because this year my taxes look great and I'll probably benefit more from that write-off next year. I can make decisions on when to do things because I understand the benefits from taxes without understanding how the tax system works. For the most part, I know enough to know which questions I need to ask when I'm talking to a CPA or my CPA, who I love because he makes me so much money. He's worth every freaking penny. Lance, if you're watching this, you're amazing. Weird business model that CPAs have, though, because I run a business. I run a truck driving school. And if somebody called me and said, we have this business for you, we want to add these customers to your business, businesses like to grow. Most of the CPAs I talk to are not looking for more customers. They have plenty. Their businesses are full. It's not a model I understand. Makes sense to them. So understanding that there are different types of depreciation. Bonus depreciation, scheduled, amortized, all of the different things. I don't need to know what they are. I know that when I give the information to my tax pro, he chooses what makes the most sense for my strategy of me wanting to show that I have right around zero profit in tax obligation and rental income money, so that I don't have taxes, but I'm still bankable. This really matters when you're still working on those first 10 mortgages in your name. Because when you start looking at some commercial products or asset-based lending, your credit score can still matter. Your work history might not matter as much. Your debt-to-income ratio might not matter as much. But taxes are very different than your W-2 income. Your W-2 income, you want to be increasing. Your rental income, you want the physical amount of money coming in to be more, while trying to maintain it a zero balance as far as tax obligations goes. Legally, it's the beautiful thing with rentals is to do this, and you would wonder why. Why is a W-2 tax so much more than a rental? The government doesn't need workers. The government needs housing. So there is an incentive tax system to encourage people to invest in housing. The government doesn't need employees as much as it needs companies. So employers pay less tax than employees do because the government is encouraging the activity that it wants. It wants businesses to grow. It wants people to invest in properties. So when you're looking at investing in rental properties, how many mortgages you can have in your name can really affect your taxes, because at some point it makes sense to pay off mortgages. Kris Krohn said it really well recently. He talked about you want your passive cash flow to come in from rental properties to cover your dreams. So most of us talk about a FIRE number when our cost of living expenses are covered. So we have housing, transportation, healthcare, food, entertainment covered. But he talked about once your cash flow from your rental properties or from your investments surpasses your dreams, after that, growth might not be as important as maybe paying off debt, building a more secure base. So there are people like Matt the Lumberjack Landlord and Michael Zuber who are growing massive rental portfolios where they recycle capital, and they are growing their income to cover their dreams and then keep growing. At some point, a normal investor, I think I'm like literally the average person. Like 2.5 kids, 2.5 marriages, average across the board. How much do you want to make before you want to stop growing? How much passive income every month is enough? And I don't mean enough to cover your expenses. I mean, for me, financial freedom happened at around $2,700 a month while I didn't have a mortgage because I was house hacking. Financial independence happened where work was optional. Passive cash flow starts to pass the 10,000 mark. What point is enough to where now, instead of adding properties and putting my money to its best job, does it make sense to pay off a property? As you pay off properties, you are going to not have that interest payment because you might then start to have tax obligations. You are still paying more in interest than you are going to benefit from. So it doesn't make sense to get a mortgage to have a tax benefit when it comes to interest as a write-off. But sometimes it makes sense to buy a property to reset and start over a depreciation cycle on a new building or set of buildings. That starts at 27.5 years again on that new property. So you want to talk with your tax pro to figure out when does it make sense to buy and when does it make sense to stop buying, because it's different for every single person. A lot of investors will say A, B, C for sales. They'll say always be closing. An investor is always be buying. ABB, always be buying. Every time you buy, you reset a new depreciation cycle. So it can make sense for some people to do that. I'm almost wrapping up on taxes here. I want to get to the questions. So I talked a little bit about a 1031 exchange. That is where you take the capital gains from the sale of one property and you delay paying taxes by buying another property that is the same value or more. Probably it has to be the same or more value. So like $1 more in value. If you're selling one property, you can buy 2 or 3 properties where the aggregate value is more than the one that you sold in order to take advantage of the 1031. There are some things like this is nuanced. You can do a reverse 1031 exchange where you buy a property and then you sell a property and you use those funds as a tax. You get the tax write-off from buying that first property. Changes the timeline. The 1031 exchange has a very strict timeline. When you go to sell a property, you're going to have that depreciation recapture and you're going to owe taxes on your capital gains unless you 1031 into another property. When you pass away, there's a thing called the stepped up tax system, which up to a certain value, which changes depending on who's in office, you can reset the depreciation value on the properties to the people who inherit the properties. That is one way to use the tax system to where you basically, you destroy the myth that the only thing certain in life is death and taxes. Well, you delayed those taxes to the point of your death, so you didn't ever pay those. You can actually make it to where your heirs don't pay those too. You can also have a trust, and a trust is the best way to handle taxes for inheritance. Enough information for an entirely different video, because this was supposed to take 10 to 15 minutes, and we're hitting the 33-minute mark. So, oops. So that's the stepped-up tax system. It resets the depreciation for your heirs. There's also another benefit to house hacking. The IRS Rule 121. If you live in a residence for at least 2 out of the last 5 years, you can realize up to $250,000 in capital gains if you're single, and up to $500,000 in capital gains if you're married, and not pay any taxes on that amount. Profit above that is then taxed as capital gains starting at that level. So there are people who, like Mindy Jensen, she does what's called a live-in flip. She moves into a property, so she's going to flip it, which means you found one that needs work, so you do the work to fix it. So she's basically living in a construction zone. You keep it for 2 years, and after the 2-year mark, you sell that property. She's married, so she can realize up to $500,000 in capital gains tax-free. Rinse, repeat. You can only do this once every 2 years. So in a 5-year period, you could technically do it twice. And you have to have lived in it 2 years of the last 5. Talk to your CPA when you go, if you're looking at selling a property, to make sure that under the current, whoever's in office, everything is going to work the same. One of the main reasons why you want to have a tax professional is because there are some really weird tax rules. As a sole proprietor managing my own properties, I can write off my internet, my cell phone, my miles that I drive for the rentals, an office space in my unit that I live in. So one of the rooms, 130 square feet, is an office space that qualifies for a write-off or tax deduction. But I live in one unit of a 4-plex. If I go to sell it, that IRS 121 exclusion means that the benefit to my gains only apply to that unit, 25% of the 4-plex. So it gets kind of tricky, and that's where the CPA comes in to tell you what your best bet is. Yeah. And then the last thing I'm going to wrap up with before I get to the questions is These tax benefits are legal. They should be a strong motivation. But again, don't incur a debt in order to get a tax write-off, whether that's interest on a mortgage or an expense that you might not have done. But anytime you have an expense and you can legally use it as a write-off, take advantage of it. There's an order of operations to taxes. Benefit from a tax write-off, but don't have an expense in order to get the tax write-off. Let me go back up here to the top and say howdy to everybody. And I have to turn off the heater because it's like a sauna in here. Almost killed me. Okay. KHPF 881. If that's an acronym or short or something, I don't know. Interesting. Howdy. Thanks for hanging out. Invest to Wealth. Howdy. Good evening. Wolfmaster 82. Howdy. Chester. Howdy. I can help with that tax question somewhat and finally put this accounting degree to halfway decent use. Nice. Awesome. Mike A. Howdy. Let's get to it. Keith. What LLC tax advantage? Howdy. Exactly. There are none. Chester. Tax deferred savings advantage like an IRS revenue code section 1031. Yep. The like kind exchange. Tiffany. Howdy. Keith. Yes. No advantages to an LLC. No tax advantages to an LLC. There are 3 times an LLC, makes sense? 4 kind of. So protect yourself from someone else's mistakes if you have partners, commercial or hard money. And for those people that some reason need to hide their name, they don't want to be known as the owner, they don't want to be associated with it, an LLC can put a degree of separation between your tenants and you. So I guess that's kind of a reason. Very easy to just, I don't know, tell them you're the property manager. Larry, howdy. Larry, pass-through entity is set up as an S corporation, vice the normal C corporation. Right. So things the CPA needs to know based on your specific situation. And if you have rental properties and you have them in your own name and you have them in an LLC name, you're going to pay the same amount of taxes. The only thing you get to write off if you have an LLC that you can't write off if you're a sole proprietor is the cost of the LLC. Somebody said that in the Facebook group the other day. They corrected me. I said, no, you get to write off the cost of the LLC. Larry, howdy. Robertson. Hey, there's a porn link if you're bored. Okay. Chester. There are so many advantages to being a business owner. It is the single largest reason why business owners can become wealthy and maybe eventually rich, but not always, definitely wealthy. Yeah, it's that cash flow quadrant, the 4 quadrants in the 30-second Cliff Notes version. Employees pay around 40% in taxes, so some are state and federal, and depending on how much you make, it could be a little more, a little less. Self-employed pay about 60% because you pay the employee tax, and then you pay the employer's side of the tax. Business investors, people who get to get their money, spend it, and then pay money on what's left, pay around 20% in taxes. And then investors, the goal is to pay 0 in taxes. So there's 4 quadrants. Robert Kiyosaki's, I don't know, 2nd or 3rd book he wrote was the cash flow quadrant, and there's your 30-second version. Lumberjack Landlord. Howdy, Matt. You and me. Looking forward to hanging out and hearing great content. Awesome. I am looking at getting StreamYard, so I will be able to have somebody like Matt on a Tuesday when he's out here hanging out with us. Ronald, howdy. HOA is the absolute worst. I do have a long list of reasons why I would never want to own a property in an HOA. I will make a video about that, but not today. Keith, howdy. Capital gains on a flip will fry your assets. Sold my HOA house this year. Yes, totally communistic. So I wouldn't, communistic. I normally wouldn't say this about somebody if they're not in the room to defend themselves. But Michael Zuber said this in one of his daily updates. He just kind of casually mentioned that in the last year, he did a bunch of flips. And so this last weekend, he was meeting with his CPA. I was actually in his town for the weekend, and I think he just used it as an excuse to not hang out with me. He just said he was busy with the CPA, so it was like, I was like, yeah, I'm busy too. I'm getting my hair did. I won't be able to. But he said doing those flips created this 6-figure check he's going to have to write in taxes, which means he made a lot of money. So that's great. But flipping is a job, and it's episodical, and it is going to incur a tax obligation and he said it himself in his thing, or I wouldn't be saying this now. He said, I wish I hadn't sold those. So that's one of the most common things. And Millennial Mike said this the other day as to why one of the reasons why he keeps his properties and doesn't sell to use the equity. He might do a cash out or a home equity line of credit. But he said, I've heard so many investors say, I wish I didn't sell that property because it's worth twice as much now. So I agree with both Mikes on that one. That's why I don't sell. Andrew, howdy. Congratulations, Andrew, on paying off. You named it the other day, and I didn't commit it to memory, but it was like $72,000 in debt or something you paid off the other day. That's freaking awesome. Chester, HOAs are unnecessary expense to me. Cannot stand them. Yeah. I won't do it tonight unless we run out of time towards the end, or if we have a time left at the end and there's no more questions coming in. I will break down all of the reasons why no HOA. Phil, howdy. Hey, Dion, any suggestions on things to be prepared before I close on my first quad and through my first year tax-wise? Thanks for inspiring taking action. Awesome. Congratulations. If you're starting with a fourplex first, that's really cool. Fourplex was my fifth. I had 5 fingers. It took me a lot long to get there. It took me 5 purchases before I got my first fourplex. So you sound like you're on track to use Matt's 4-3-2-1 method, which is really cool. Email me, Phil. I'll put my email in the chat. If you haven't got it yet, I would use my spreadsheet to keep, at least if you don't have a software like Stessa or something where you're tracking your expenses, I have a really simple spreadsheet. And when I say simple, I mean like a kindergarten version of simple. Here is the date the expense happened, where the expense happened, the price, the tax, because those have different tax write-off implications. In some cases, the tax is always 100%. The other one could be, I don't know, CPA knows the difference, but they need it. And then which property it was assigned to or unit it was assigned to, and then notes explaining what it was, because that'll tell them whether it's scheduled, amortized, or whatever type of depreciation they're going to use. Very, very simple spreadsheet. I'll send that to you. Get familiar with the Thumbtack app so you can find contractors, get quotes, and read reviews. Have a list of at least 3 plumbing and electric companies in your area that have 24-hour service. Plumbing is more important than electric when it comes to that. If you have an electric problem that requires an emergency midnight thing, it's probably the fire department instead of the electric company. But plumbing, you want to have 24-hour service in case you have a septic backup or a break in a wall or something. What else do you want when you're starting? Local REI meetups to find the handyman, get 1 or 2 in the area, talk to other investors to get reviews. A lot of times it's a lot easier to have a handyman fix something than calling a contractor. A thumb drive for things like leases, tax returns, pay stubs, bank statements, things that your lenders are going to want going forward for that next purchase, because now you have the fourplex in your debt to income ratio. Since you're house hacking it, you're going to want to keep all of that. I mean, some of those things like wages, they're going to get currently when you go to do the next one. But keeping it on a thumb drive so that you can easily access it all in one spot. A lot of people will have like a filing cabinet where everything is located. I have one of those, but the thumb drive goes everywhere I go and it has everything. I've been in other state. One time I was in another country and I had to send a couple things to the lenders. Always want something new. Every time you close on the next property, it's going to be something you haven't thought of. So keeping all those documents together will be good. You have your leases. If you already have it, I hope you probably already have your leases. I would get those. You probably don't need it with your first fourplex. It was 3 or 4 properties in where I just paid an attorney to have them on file as a, do the research in your area, find a very aggressive eviction attorney, because you are not going to need an eviction attorney's service until you need them to be aggressive. So that's not you being aggressive. That's you thinking logically. When we've got to the point where our communication or our property manager's communication is no longer working, you want an aggressive attorney and give them a retainer. Get them on your books. It's usually $1,000 or $1,500, and it might be 2 or 3 or 4 years until you ever use them, but have that there. And it could be, sometimes I've done this before, where the attorney sends a letter instead of me when I know that it's a lease violation where I don't want to do an eviction. It's just something stupid like somebody in the house who's not on the lease, or a pet that wasn't agreed to, or something like that. A letter coming from the attorney can have more weight than you do, and that'll eat up, one letter will eat up a couple $100 of your retainer with them, but it's worth it in some cases. So cool. I have, a couple of weeks ago, I did a live stream buying a rental before, during, and after. And in those first 30 minutes or so, I covered what you do after you close on a property. So if you want to find that, I don't have the numbers memorized, but it was 2 or 3 weeks ago. I might check out those first 30 minutes of that. Larry, this makes me think of SE versus business owner versus investor in Kiyosaki's cash flow quadrant. Yep. Like, what's it? Geniuses think alike, I don't know, something. Smart people think the same. Chester, tax avoidance is legal because you'll eventually pay them. Tax evasion is 100% illegal. It is. Yeah. Chester, cost segregation and bonus depreciation. Yes, those are things that people can use. Cost segregation works a lot better if you or your spouse is a real estate professional, and there is a list of requirements to hit to do that. You don't have to be a real estate agent, but you have to be a real estate professional. Michael Zuber has got several videos on how that works. He actually did it this year. Matt, the lumberjack landlord, did that this year too. Chester, timing also matters with taxes. Absolutely. Phil, all great reasons to be learning here at YouTube University. I agree. Although sometimes we have to be careful what we learn on YouTube University. There's a video, there's a content creator, not a video, a channel I watch. I like the guy. I've been watching him since he had like 50,000 subscribers. He's got over 400,000 subscribers now. So if you're ever bored and you want just kind of low key, really relaxed financial stuff, background noise, Richard Fain, Fain, good content. But in the last 2 months, I think the man's lost his ever-loving mind. Selling his house because it's appreciated so much, because he's going to wait 2 years for the crash to buy in again. Selling all of his cars because of the chip shortage. They're worth more money right now. So he's turning everything he has into cash, which is being eaten by inflation. And what if there is no crash? Like the Three Amigos are saying, there is no crash coming soon. There's a slowdown, there's a softening, and there was something else he said too. Oh, sell all your real estate and buy stocks. That was the video where I thought, okay, we've jumped the shark, which there's probably 3 people here old enough to know what that reference even means. But yeah, always be careful of the information you take from some random guy on YouTube. Random guy on YouTube, as Jaspreet Singh always says. So whenever you find out something, trust but verify. Because everything said on the internet is absolutely true. Abraham Lincoln. Chester, net operating loss carry forward. See, so we've got an educated person here, which is good. And the great thing about hiring a tax professional is like hiring an agent, a real estate agent. I don't have to know the rules. I have to know that the person I hired knows the rules. Pallavi, howdy. Welcome to the Facebook group. Saw you join that the other day. Chester, net operating loss or nulls allow business owners to file a refund for taxes for up to 2 years from the loss and automatic business deductions for up to 20 years forward from the year of net losses. Cool. Rob, howdy. Can I write off the time you spend watching the Three Amigos? You can write off YouTube Premium, which also saves you crap. I didn't put that in my spreadsheet. You can write off YouTube Premium because you educate yourself here. I wrote off the one rental at a time course. Even though I took it to do a review, I still took it. I am going to be this year writing off Chandler David Smith because I'm going to take his course and do a review of it. But you can write off educational stuff. Not so much the time, but the monthly expense. Jimena, hola mija, ¿cómo está? Good evening. Rob, I speakish goodly. Words are hard. Jester, business expenses are known as above-the-line deductions, which are the most powerful. They reduce income at a dollar-for-dollar rate. Personal expenses are below the line and reduce income at a, and then my chat moved. Great. I moved a lot. At a fraction of the expense amount based on the marginal tax bracket, which is why in the note section of my spreadsheet, I put specifically what the expense was for, because then the CPA will know which category to put those in. Phil, good question. Chester, those are numbers which make it difficult to game the numbers when it comes to the amortization schedule. True. Most of the tax is a legal loophole game where the government is basically always playing catch up with enacting tax laws. Usually, right? Million, hi, howdy. Chester, CPAs have tons of regular work, usually come busy, especially this time. Yeah, you can't find a CPA from January to April, but my CPA year round said, no, I'm not looking for any more business. I was like, I have a YouTube channel. You're a good CPA. I know people are going to want, because people have reached out. Do you have a recommendation for a good tax professional? And I was like, nope, because he doesn't want any more. Yep. And Esther, howdy, took the message back to make me lose sleep tonight and wonder forever what was said. Phil, P.S. Since I'm in Alaska and so is your CPA, think he'd take me? I don't know. I like I said, I've asked twice. My CPA is not taking on new people. Chester, based on your area is 10%. It must have been a question about 10% cash on cash, good or great deal, or 6% or 7% in your market. For those taking notes, make sure your CPA is part of your team. Yes, your CPA should know you for years. They don't have to. You can switch CPAs, but they know your depreciation schedule. They know what last year looked like. Doesn't mean if you have a bad CPA that you don't switch to a better one to try them out. Chester, stepped up tax basis is the main way of passing along inheritance, again, legally. Jimena, please make a video of inheritance in the future. My will to my kids is going to say, being of sound mind and body, I spent every freaking dime. You get nothing. That's not true. My actual will says that the assets will be divided amongst the three of you equally, unless one of you spends a penny on your mother's, then the other two get everything. That's actually in my will. So Esther, is there a CPA real estate recommendation in Seattle area? Thanks. I don't know, but BiggerPockets has some ways to search, and those forums might be the best way to find one here. Local REI meetups, finding real estate investors, asking which CPA they use. I think I'm the odd one. I don't know that everyone's CPA is probably saying, no, they're not looking for more business. It's just mindset. And I'm not the person that's like, oh, mine's good, I'm going to keep them to myself. I share my handyman. I share the contractors. I tell people which roofing company to use in this area. Like I've got a local Facebook group called Tacoma Fi, and in there I talk about the person that runs the cleaning company. I've got a cleaning service that's like super professional, like the best rates. And I share her information. And then if you have a tenant flip or if you have a commercial business where they need cleaning, I tell people, these are the people I work with, give them business. My CPA is just weird. James, howdy. Esther, good to know LLC has no tax advantage. Yeah, no tax advantage and no real asset protection unless you have partners. And just in case anybody hasn't heard me say this for the 100th time, when I hit 10,000 subscribers, I'm going to make it a rant. I have got 2 rant videos, and I don't like to make them very much because some people have pointed out they don't like my rant videos because it sounds like I'm being condescending. It's because I usually don't let anger or emotions or frustrations show in the way I talk, especially when I edit a video. I literally go back and, ooh, the whole thing was terrible. Get rid of it. But when I do a rant, I just stream of consciousness talk with no filter. And that can seem condescending when I'm saying, people say Zillow is manipulating the market because of this. And then I point out how they're not. Well, I'm disagreeing with somebody. So that sounds condescending. When it comes to the LLC rant, I'm going to be a dick. because I know some people are suggesting LLCs to new investors, and it is stopping them in their tracks. It makes lending harder. It makes interest rates worse. It makes insurance costs more expensive. It like puts all these barriers in front. Like, what is credit history when you create an LLC without giving them the benefits that people say they do? And that rant is going to be mean. And I'm assuming a few subscribers are going to leave. And I want there to be some people left. So I want to wait till I hit 10,000. But I'm going to be really clear on all of the things that an LLC will do for you and all of the things that it won't, that people think it will. Mr. Banks, howdy. When subtracting the land, it should be 10%. That is not something I know how to run the calculation on, because if you own 5 acres and you have a 2,000 square foot building, it's going to be a different metric than if you have 1 acre with a 3,000 square foot building. So it's not like there's a percentage based for the land. It's Chester probably knows, but it's some CPA metric that'll take how much of the land does the building cover, because that gives you some percent ratio, and then it'll be, so it's unique to the property pretty much every time. Antonio, howdy. I always want to say Banderas when I see your name, but that's not right. Howdy. I'm trying to purchase a fourplex. Ideas if I can work with multiple lenders and realtor for better rates and better performance. So yes and no. I work with several agents who set up auto searches. And when they send me a property, the agent who sent it to me first, if it's the one I want, makes the offer, gets the deal. Matt says it great, the lumberjack landlord, when he says, dance with the one who brung you. If that agent found me the deal, they get the commission. And I work hard to make sure they get the commission. I don't try to talk down their rates or anything. I want them to make money because that motivates them to bring me future deals. And in real estate, this is a very finite world. Your reputation will last decades. And if you're known as the person who tries to talk people out of their commission, nobody's going to want to work with you. So I make sure my agent makes money. But they know there's at least 3 agents with auto searches set up so that I have the best chance at finding a property quick, because in a hot market like we see now, speed is your friend. The faster you can get an offer in, the more likely you are to get it accepted. In 10 years, working with at least 3 agents at all times, some of the names have changed, some of the faces have changed, but it's always at least 3. One time ever have my agents sent me the same deal within 24 hours. It was still the next day, but searching on the MLS is nuanced. And if you're searching on Redfin, Zillow, Trulia, any of those places for properties, you are seeing dated material or the few people who list on there. Every time I've seen the properties that I have found, offered on, closed, got a rental in, months later, I see it pop up on Redfin and Zillow. So it's dated material. You're not in a timely manner going to get an offer and to get it accepted. So I want searches happening on the MLS. Even if I was an agent and I had full access to the MLS, I would have at least 3 agents with auto searches set up, because we all search differently. But once you get a deal from an agent that they sent you and you want to make an offer, work with that agent to protect your reputation. That's agents. With lenders, here's the order of operations for lending. To get the best rates, best fees, because it's not just rates that always matter. Sometimes the amount that it takes to buy down a rate can be better and get you the same rate for less money. I work with a large bank first, Wells Fargo or Bank of America. And because they have the most standardized criteria, I figure out how much I'm allowed to borrow based on their standardized criteria. I make my offers on properties. As soon as I get one accepted, I go to other lenders. I go to Fairway Mortgage, Guild Mortgage, used to use credit unions, never had luck with any of them. And I say, here's what the bank is offering me. This rate, this down payment, this is how much it would be to buy down the rate in writing. And I show that to those other lenders. And I give them a chance to beat their rates or fees to keep my business, to get my business. If they do beat that original offer from the bank, I take that offer in writing back to the bank to give them a chance to keep my business. The first 2 or 3, it was 3 properties went to Wells Fargo. And it was actually my Wells Fargo rep that taught me this strategy. She said, I can't go to my boss and say, I really like Dion. I'd like to give him a better rate. But I can take another lender's offer in writing to my boss and say, in order to keep Dion's business, this is what we need to beat. And then they could. So for the first 3 investment purchases, Wells Fargo kept my business. Since then, Fairways beat them every time. 3 more purchases and 2 refinances went through Fairway. And now I'm working with Matt, the mortgage guy's team, and we'll see how the next one goes. So that's how I work with multiple agents and multiple lenders and be transparent. And everybody that I work with knows that I'm going to be dancing with several partners. And the irony of what I just said. Where did I go? There we go. SZG. Howdy. Dion, I have a perfect opportunity to use your binder method on my tenant. What do you recommend to use for a current rent comps in the area? Current listings from apartments.com and Zillow is what I used on my last, it's in the truck. Should have brought it up. I thought about bringing it up. I just used the binder myself about 3 weeks ago. And I'm so organized, it's still sitting in the back seat of my truck. Look at apartments and Zillow. Look for the properties that seem extremely low and check to make sure that if there are properties that are low income, I don't use those in the binder. And then apartments.com to get the map for where the rentals are in the area. And the comps are from there. I don't use Rentometer anymore. They have improved from going through a 1 year historical data to a 3-month quarterly historical data, but they're still a bit off. I want, when the person goes online and looks at apartments.com or Redfin or Zillow, they're going to see the same places I bring and show as examples. So let me know how that goes. Keep me updated. James, howdy. Do you recommend USDA investment to build a house? There are times when buying becomes so expensive, it makes more sense to build. In my opinion, it doesn't make more sense to build when the supply chain issues are causing the building to take longer, to increase the cost to where you have to figure out which one actually makes more sense when you're looking at both. So, and we made it 1 hour and 3 minutes before the voice started to go. And obviously this is a new Mountain Dew. My assistant screwed me over and didn't give me my vodka Mountain Dew. Hopefully you just learned 2 things. I don't actually have vodka in my drink and I don't have an assistant. So to build, it depends on your situation. There are several ways to purchase land and build with different loan products. And so talk to different lenders to find out what your best options are for your area, because it changes state to state and possibly even county to county. If it makes sense and you have the right end goal, sure. If you're looking at only having it for a couple of years and new builds, it's a whole different world than what I do. I prefer to buy 20 to 30-year-old properties that already have tenants in place. So I haven't looked at building. Matt, the lumberjack landlord, is looking at building 3D. There's a video on my channel called Build or Buy, and I have the 3 amigos talk about that. So that might be a place to get the best information because they've both done more of that kind of stuff than I have. I've never even done a rehab. I am the lazy investor. I want rent ready or already occupied, cash flow from day one, super easy. Doesn't grow or scale as fast as a lot of people's, but it made work optional in 8 years, which was my goal. So whatever your goal is can determine which way is the best way for you to go. Tennessee, Tweety, howdy. What's a recommended book to educate yourself enough on taxes to be able to ask a CPA? Good question. Could have swore BiggerPockets had one. I don't know that I would go for a book on what questions to ask. I would literally go to the second largest search engine on the world, YouTube University, and type in, what questions should I ask my real estate CPA to build that list? I don't have a book recommendation for that. How did I find my CPA? So Lance does the business taxes for, so networking to find my CPA. If you know somebody who has rentals, who do they use? Local REI group, who do they use? The questions, so I don't have a book recommendation, which was your question. I would ask the CPA, do you have a focus on real estate? Do you understand how depreciation works? And here's the main thing to remember when you're talking to a lender, a CPA, a real estate agent, somebody who works in the business. They are not your mentor. They are not your partner. They're a part of your team. Your agent's job is to close deals. Your lender's job is to sell mortgages. Your CPA's job is to give you the best tax benefits that you can legally get. All three of them would advise you to do different things. The first agent I worked with was an investor, has over 30 rental properties, is completely financially free. If I listened to him on the first two properties that he had me making offers on, I would have went bankrupt. Both of them would have been alligators and I would have lost. I would have never gotten anywhere in investing. Luckily, I did not get those offers accepted. And throughout my self-education, I learned to ask things of my agent, like when you're taking advice from them, you want to know, have they invested in the asset class that you're investing in? Have they done things like you used a mortgage or paid all cash? Do they invest the way you do? Because their advice is going to be very different based on how they've invested. CPA, you're going to make sure that they're giving you tax advice. Most CPAs and attorneys are going to tell you to have an LLC. They're going to say, look at all the asset protection you get, because they get paid to set it up and maintain it and file taxes on each one. So imagine that they want you to have them. So they're not your mentor to get advice from. They're your CPA, your tax professional to get your taxes done. Hope that makes sense. Tennessee, how do you know when you've found a good CPA? Easiest way to test in the beginning, and this could cost you money in the very beginning. First of all, if you've used networking and you have somebody's recommendation, that's usually your best bet. Try to do your taxes yourself with TurboTax, the free version, to see what you would come up with. Compare that to how your CPA looks. I've never done this, but you could hire a CPA and then have another CPA review their work. It's going to cost you a little bit, but in the beginning, if you're looking at a relationship you're going to use for decades, that little expense might be worth it. Rob, are you going to the BP meetup in San Diego? I have to find out when that is. If I'm going, I don't know when that one is. I know that there is, BP is going to the Rich Dad Conference. I think that's in Arizona. So Brandon and some other people are going there. I was invited, don't know if it'll actually come through, to be a guest speaker at BP Con, which I think is in October, which they haven't selected a location for. So we'll see on that one. So if I'm a guest speaker, I will be at that one. But I'm not sure about the San Diego one. I'll have to do some research and look. Chester, what kind of documents do lenders typically want when applying for a mortgage as an investor? 2 years tax returns. Any K-1s if you run a business with your tax returns. 2, sometimes 3 months bank statements, because if you have reserves and a down payment, they want to know that it has a known source, that it's seasoned and it's yours, it's not a loan. Current bank pay stubs, and they're going to contact your employer and ask what is the likelihood of continued employment. Leases, so in the first 2 years, debt to income is kind of a big issue. You can't buy more properties than your income can justify. Most lenders will, if you buy a fourplex, will look at the rental income from the other 3 units. But as you're adding more properties in those first 2 years, they don't like to use rental income in your debt to income ratio. When they do use it, they're only going to use 75% of it. So you need to be buying cash flowing properties for this to work. But once you have tax returns for 2 years with rental income on them, lenders will start to recognize 75% of rental income from the properties you own and the property you're looking at buying. The lenders will prefer that the majority of your leases have at least 3 months remaining, which makes month-to-month leases less attractive. There are some lenders that are finally looking at short-term rentals like Airbnb and saying, well, as long as we have a 2-year historical data, we can start associating that with your income too. But that's not 100%. It's just starting to happen. So a good reason to have longer leases is because lenders want to have 3 months remaining. And it was a little confusing to me the first time I heard a lender say that they're going to let me make a 30-year commitment for hundreds of thousands of dollars because a tenant would make a 3-month commitment for a couple thousand in rent. But the lender explained, we're not going to give you a mortgage and then keep it for 30 years. We're going to give you a mortgage and usually within 2 or 3 days, sell it on the secondary note market to someone else. We might even still collect your payments, but somebody else is going to own your mortgage. So we want those first 3 months covered by leases so that we know we're not going to be stuck with you not able to pay your payments. That'll be the person's problem when we sell it to them. So that makes sense. What else do I have in my thumb drive? Tax returns, K1s, leases, bank statements, pay stubs. Be prepared to write an LOE for anything that seems odd, a letter of explanation. Why did you have a large income 2 months ago? Why did you write a check yesterday for $1,000? Whatever the thing is, you're going to have a letter of explanation to explain things like that. And I'm surprised every time the lenders come up with something new that I've never seen before. So that's not like I have made a comprehensive list of what to have together. Be ready to get that stuff. I like to have all my stuff together and kind of shock the lender by just, getting into whatever portal they use and uploading all the documents that they're going to need, because the likelihood of there being a delay in your closing is very high. So I don't want that delay to be anything that I caused, if I can avoid it by getting them what they need. Mike, howdy. What was the name of the expense tracking software you mentioned earlier? Excel spreadsheet. Let me put my email in the chat. So feel free to email me. I should probably I can't put, there's probably some way to put an Excel spreadsheet into the YouTube thing, but I'm not a 10-year-old, so I don't know how to run this stuff. But if you email me, I'll send you a copy of my Excel spreadsheet, and it's just how to track income and expenses. It's the spreadsheet that I send to my CPA. It'll be blank if I remember to send you the right one, but it'll have the columns and how I list everything out. There is Stessa is one. Hemlane is another one, kind of like a software that tracks your rentals and can probably produce those. I don't use those kind of softwares. Running rental properties can be as complex or as simple as you want to make it. I use the KISS principle. Keep it simple. 16 rental properties, 1 checking account, 1 savings account, 1 credit card. Pay the credit card off daily so I never carry a balance or ever have to think about it. 1 Excel spreadsheet with a tab for expenses and a tab for income that I send to the CPA, and I sleep like a baby. In most areas, you have to keep a separate savings account for deposits because that's not technically your money. You need to keep that separate. So check your local laws. But that's it. That is as complex as my business gets. My actual business is in this book. Everything I need to run my business is in this book. It doesn't take software. It doesn't take a laptop. It doesn't take a computer. It doesn't take anything. You can run a rental business from your phone, and I have pen and paper book that runs my entire business. As simple or as complex as you want. And I sent one to Mike. Let's see if he ever uses it. Look on his shelf behind him in his new office. You'll see the book there. SCG. I always want to say SG1, which is a good show. So Section 179 is usually advantageous because state does not allow bonus depreciation. Yeah, that was, I believe, done at the executive level federally. And we're going to start tapering on that now. It's where it was 100% last year. Now it's going to be 80, 60, whatever. That bonus depreciation is going to be going away. Robert, howdy. How would you go about structuring an off-market deal seller financed, also closing costs in this situation? I would myself probably go through an agent because I make my offers through my agent, even for off-market deals. If I wasn't going to use the agent because I found the deal, I found the seller, and it had nothing to do with my agent, I would probably find a real estate attorney and have them structure the deal and make sure that it worked for both sides. Make sure I understand the question. So also closing costs in this situation, generally, when you're buying, so you said seller financed, right? Seller financed. The seller is usually trying to avoid capital gains, so they don't want to make a bunch of money, but they also don't want to write a check. So if you have an agent, and your agents, maybe they've got an agent too. It's possible seller financed off market, they might be using an agent too. They just never put it on the MLS. 6% for agent fees. So your down payment needs to be the amount of money that they are wanting to walk away with so that they know how much tax obligation they're going to have or whatever is left on their mortgage they need to take care of. But it also needs to cover the agent fees. Your down payment should also be enough to cover the attorney fees to make the sale happen. You're probably still going to sometimes have an inspection. You might waive it. Generally don't need an appraiser because you're doing seller financing. It's one of the benefits of seller financing is you don't have the delay or possible problems that can come up from having an appraiser. So a real estate attorney or your agent is still going to be involved with me for an off-market seller financed deal. And then structuring it is going to make sense. I've heard some people say, well, it's easier to get an off-market seller finance because you just offer more than the property's worth. Okay, why? Maybe they'll sell it for less. So that each deal is going to be unique. And then some people say, well, I don't really want to do seller financing because I don't like the higher interest. Well, what the heck makes you think it's a higher interest? The seller doesn't know or care what the interest rates are. You're going to be paying them some interest. So it might even be lower than what the current rates are. Each deal is going to be unique based on what you and the seller will agree to. Rob, I'm on the fast track. Needed the attorney for my first rental in the first 3 months. I love California. Yep, but attorneys, they earn their money. That sucks. Sorry, Rob. James. Chester, quit asking so many questions. I don't know if he was asking questions as much as trying to share information. Rob. Jump the shark. The Fonzie. So there's someone else here that's over 20. Chester, could you do a review of Todd Baldwin's house hacking course? It's a good point. So I want to share information and I want to take courses to give reviews. I'm trying to think of the better way. It's not that I'm a cheap bastard. It's that. So I don't have a course. I'm not selling books. I don't have swag. I don't have, stuff we all get. I don't have stuff to sell. So I'm not generating money off of this. So I don't, and I've been house hacking for 10 years. So it'll come down to the price point. Because when I thought Chandler David Smith's course was, $1,000 or $2,000, I was just going to say, don't take it. Then I found out the price point was, a couple $100 or $100, or there was somebody sent me a discount for $100 or something like that. I was like, I could spend $100 or $200 to do this. So when I look at his course, depending on the price, I'll probably take it to give a review. And I've had Todd on the channel, and he lives right here in Seattle. I'm here in Tacoma, and I love the information that he puts out. If the course is good, I'll say it. If the course is bad, I'll say it. Same thing when I took Michael Zuber's course. I was like, hey, I've been on your channel. I like your stuff. I'm going to take your course and I'm going to do a review. Like when I reviewed his book, One Rental at a Time, I said, I'm going to listen to this and I'm going to give a review. And it was really cool. Chandler said the perfect thing. The same thing Zuber said when I said, hey, I'm going to take your course and do a review. Chandler said, cool. Just be honest. That's what you want. You want the person to say, all right, great. Let me send you some shirts or some books or some whatever, and then you just give me a better review. No, he just said, just be honest. And both of them said that. So I'll have to look into Todd Baldwin's house hacking because he does buy the room, and there's some pretty good strategies in there that I probably haven't thought of yet. So I can actually benefit from taking the course. James Chester, read a book. SCG. I'm a CPA and busy season is in fact hell. Yes, no kidding. Chester, I get to all the questions. Just ask what you want to know about. I'm going to go through. I get to all the questions, and I encourage. This is sometimes conversation. People, Chester shared information tonight. I just don't know. I wish I talked faster. Then it would be easier because some people will come back and watch this on like 1.5 speed to get through it quicker. REI Stoners, howdy. Are you guys in Washington yet? And just mailed my taxes today. I didn't think about writing off Michael Zuber's class. Yep. So you'd have to think, is that much money worth an addendum to it? But yeah. Javier, howdy. This is my first year doing your taxes. You have 2 duplexes, and the banker said to me not to report losses this year so I can qualify for more loans. Well, you don't want to report a bunch of losses. Ask your lender what they do with depreciation. The lenders that I'm using, the ones that I've qualified with, said we take depreciation out to look at your profit. So you might be able to show a loss with a whole bunch of write-offs that looks like a huge loss, and now you're not bankable. But you could show pretty close to zero, and then depreciation is on top of that, and they're fine. So check with your lender specifically how they look at it. Why is my phone freaking out? Sorry. Okay. I have a handyman. I feel like Matt on a Sunday. I have a handyman fixing a shower at a tenant's house. So if he's going to work in the evening, I'm going to answer the phone, but it's not him. Yeah, you don't want to show too much of a loss, and that's more of a write-off concern. Keith, hit that like button. I would appreciate it if we hit that like button. If we get 100 likes on this video before we're done, I'll dye my hair blue. I guess that really only works for Zuber. Larry, I think, oh wait, that was from Keith. Howdy. Thank you for asking to hit the like button. I appreciate it. Larry, I think a trust is probably better than an LLC for purposes of anonymity plus other benefits as well. I would totally agree. That's probably better. Trusts are a bit more expensive to set up than the LLC. Most people can do the LLC themselves for a couple $100, whereas a trust is, my experience, an attorney, and a couple $1,000. Gesture. The fraction of the whole land that the building covers is what gets deducted, basically to identify land and land improvements. Yep, exactly. That is the buildings being an improvement to the land is one of the reasons why most places don't want mobile home parks to exist. And some statistic like 1% to 2% of mobile homes in the United States, the mobile home parks, goes away every year and they're not being replenished because taxes, property taxes, they don't base the tax on the value of the land. They base the tax on the improvements to the land. And since a mobile home is mobile and has registration, it's not an improvement to the land. It's not taxed. And so it's actually like a double whammy. Most mobile home parks have families that have kids. So the kids use things like the school district and sometimes the state health benefits. But their property isn't contributing to the property tax, which supports some of those programs. So there's a lot of reasons why actual municipalities are fighting to get rid of mobile home parks. So land improvements being the building. Yep. Do you get to deduct the interest paid on a mortgage as a business deduction or a personal deduction? It is the same. So it's not that it's an above the line. It's a write-off to the amount that you would pay. It's not a 1-for-1. It's not a tax credit, but it's a tax write-off. So it's not considered different business or personal. It's just considered, it lowers the amount of income by that amount of interest. So I've never known the difference between business and personal. And I know you said something about above the line and below the line, but the mortgage interest it takes an amount, the exact like 1-for-1 amount off of what your rental income would be. So it's not a fraction of it. James, hi Dion, have you ever considered Airbnb for quicker cash flow? I've considered it and I'm probably going to do it. One of the reasons why I like long-term rentals is because I still work a full-time job. I self-manage 16 rental units and I run a nonprofit. And I have a YouTube channel that takes about 30 hours a week. So a little bit busy. Airbnb can make more money, even if you hire an Airbnb manager. So I'm not even adding to my workload. Most of my properties are small multifamily. I do own 2 houses. One house is on a property with a duplex. I call it a triplex, but it's really a house with a duplex. Not sure which one's the ADU. If either of the houses ever become vacant, my plan, I just did the binder strategy on one of the houses, and in my mind, I was thinking if this tenant doesn't want to renew, that's kind of cool. I'll try out my Airbnb here because I don't really want to do Airbnb in my small multifamily because one side would be short-term tenants and the other one would be long. I'd have to have both vacant at the same time and then start Airbnb at the same time. So that's possible too. Airbnb does make more. And here's where I said I've considered it. And so unfortunately, the tenants in the house asked for a $325 a month rent increase. So they're still there. Unfortunately, I'm making more money. Real estate's awesome. And the tenants are happy. They're still, because of rent super inflation of the last 2 years, they're still below area average market rents. So they're getting a good deal. And remember, if you're setting rents, what someone paid last year and your expenses have nothing to do with what the rents are. Area average rents set the rents. And area average rents was even higher than the $325 that they did the increase of. So they're still getting a good deal. I'm getting a good increase. But I was going to do Airbnb if they moved out. Here's what I consider when I'm buying a property. If you're going to buy a property and do Airbnb, don't buy a property that only makes money if it's Airbnb, which does get 2 or 3 times the rent amount that you would get with a long-term rental. Because rule change, legal change, HOA, municipality, something in that area can happen where you can no longer do Airbnb in that area. And now you have to go long-term rental, and you might not be able to, you'd create an alligator where you lose money every month on the property. And now the property is going to lose value because that whatever changed in that area made Airbnb just not an option. So now you're stuck with that property. So if you can buy a property that makes sense as a long-term rental, maybe it doesn't get your 5 or 10% cash on cash return that you're looking for, but it still makes some money. And then you benefit from Airbnb while it's a possibility, sure. But that way, if it goes away, you don't become an alligator property all of a sudden. It becomes an okay, not so great deal. That's what I've considered when I thought about Airbnb. Aldo, howdy. Dion, I had a pre-approval letter for a conventional loan, but my investor got cold feet and pulled out. I still want to buy a property and willing to live in it, FHA, but banks want me to wait. Banks want you to wait. So there must be something in your situation where you don't have 2 years of income in the same field, or your debt to income isn't where they want it, or something else. And I have a video on my channel called FHA versus conventional. If you are buying a single family house, conventional is usually better than FHA. If you're buying a house with an ADU, 2 houses on one property, that's still single family house. Conventional is usually better than FHA. If you start looking at a duplex, triplex, or fourplex, now FHA starts to look better because an FHA is always 3.5% down. Conventional for your first house is only 3% down, single family or single family with ADU. On a duplex, triplex, or fourplex, some lenders want 15, 20, or 25% down, even for owner occupied. Now that starts to be a whole bunch of money to save up. It's the way I go. My first one, I did 5% down for a conventional and a duplex. Those aren't an option anymore. Right now, most lenders aren't taking that. So I probably would have went FHA with that one. Once I included house hacking to increase my savings rate, and I started getting cash flow from my single family house, and I was saving up over 2 years, I put 20 or 25% down on every property, even if I'm going to live there. I like the equity position that starts with. But in the beginning, when you're trying to save up that 3.5, or 5% down to move into a place, conventional is usually more attractive. Primary mortgage insurance goes away. So when you take out a mortgage with less than 20% down, so VA loan, if you're in the military, you don't have mortgage insurance. But FHA or conventional, if you're doing less than 20% down, you're going to have mortgage insurance. With FHA, mortgage insurance lasts forever, the length of the loan. So either you sold it, refinanced out of it, or paid off the property. Those are the only ways to get more to the mortgage insurance. With conventional, as soon as you hit 22% interest, 22% equity, words are hard, mortgage insurance goes away automatically. Even though they say automatically, I'd still check with your lender right around that time to make sure it goes away. So if you're looking to buy, I would look at conventional loans for single family or single with ADU, FHA for duplex, triplex, or fourplex, and then shop different lenders to find out what your options are. And when they say wait, I would ask them why. It's the thing I took from David Green from BiggerPockets. Whenever you get a no, say, okay, but why? Sometimes it's, well, your debt to income ratio is a 44 and we need a 42. Oh, so if I take care of these 2 things over here and then get rid of that debt, now I've got a 40, I can do the loan? Yes. Well, if you didn't say why, you wouldn't know that. Or you need more time in your industry because you have to show income. And that's when you're doing FHA loans, they're looking at your credit score, your work history, your debt to income ratio. You can talk to people like Alex, a friend of mine who works for Certain Lending, and they do asset-based lending. So 1 to 4 units. How will this property perform as a rental? Your credit score still matters. Your debt to income ratio doesn't matter so much. Your work history doesn't matter so much. Now they're looking at the property. I need to have Alex on my channel to do a video on how asset-based lending works. We'll take a note somewhere. So you have a couple of different options, and lenders are not all built the same. Definitely talk to different lenders to see what your options are. Lenders are so not built the same that when you talk to a lender today and then you talk to that same lender in his same office or her same office 2 weeks from now, you can get 2 totally different stories. The only real advice I have as far as lending goes right now is a lot of lenders, because transactions are becoming smaller. When we have interest rates go up, this is something else that was said on Richard Fain's channel, which really bothers me, because this is simple math. So many people say this, it sounds right. If interest rates go up 1%, that means that home values come down 10%, because the math works like this. The home buyer buys on payment, whatever they can afford to pay. So if the rate goes up, then the house price has to come down 10% to keep that payment the same. Sounds like it makes total sense. Absolutely logically makes sense if you don't think about it. Because as soon as you think about it, you realize interest rates don't set prices. Wages do. What a person makes tells them what they can pay every month, and what they can pay every month can go up. And then you stretch it out to a 40-year loan, and now people can pay more to have the same payment. So was why Richard said, I'm selling my house because in 2 years, prices are going to be so much lower. I'm going to buy more house and have a bunch of money in my pocket. Well, he's going to be paying more in 2 years. Have the cost of selling, because he's not doing a 1031 because he just wants the cash. Now, he will be doing owner occupied, not pay the up to $500,000, but he's going to have the cost of selling, agent fees. He's going to have the cost of buying, loan origination fees, agent fees, or whatever is going to be in that price, appraisal. It's just bad idea. I wish I could get a hold of him somehow and say, have you sat with somebody and talked about this? I need to deconstruct my own segue. That's interesting. So you had the pre-approval. Talk with other lenders to see what they will do, and ask what your best options are. SZG. I will add, most CPAs will know the basics for the residential real estate situation. The numbers is for large commercial developers. I would recommend to prioritize responsiveness and price. Responsiveness is a great one to bring up. I'm the same way. And I've never really thought about it much with the CPA, because I generally deal with mine tax season. But when it comes to lenders and agents, if they don't respond in minutes, they are no longer on the list of people to contact. Aldo, before replying for a new loan, and how does all this affect me? Before replying. Wait, hi Dion, I had a pre-approval letter for a conventional loan, but my investor got cold feet and pulled out. I still want to buy a property and willing to live in it, FHA, but banks want me to wait. Before applying for a new loan, and how does all of this affect you? I think I answered that question. If I didn't, ask again. I think I got there. Memory didn't follow the question. Sorry. Investing in rentals. Howdy, like the name. I found your passion. Or is that your whole name? Investing in rentals, I found my passion. That's even a cooler name. Hey, Dion, I work with 2 contractors for renovations, and one gets it done quick and the other is significantly slower. How would you set a fire under the slower contractor, so to speak? Thank you. So there's a triangle when it comes to contractors, mechanics, or anybody. Quick, good, cheap. You can pick 2. Generally, that's it. Quick and good, quick and cheap, cheap and good, not going to be quick. So that's the triangle. Quick, good, cheap. But to motivate the slower one, I usually say, give me your estimate, compare the estimate with the other contractor, make sure you got the one that's better. And then I say, all right, I need this done by next Friday. And here's your price. And there's a $500 tip if it's done Friday. If it's done Saturday, it's $250. If it's done Monday, you get what your contract says. Whatever the size of the deal, if you're doing the $100 sink repair, you're not going to add a $500 tip. But if you're doing a $5,000 deck build, a $500 tip might make sense. So I would do a structured, time-sensitive tip that they know about in advance. That would be the way. I like to use the Thumbtack app when it comes to contractors, because one of the things I mentioned early on in the conversations is I really like using Thumbtack with contractors like you, because I got to read a bunch of reviews about your work, like the review I'm going to leave when you're done, which will include timeline, quality of work, price comparison, that kind of stuff. So those are usually kind of tech savvy contractors that got on the app for Thumbtack and they're paying for the privilege to be on there, and they know that they are made or broke by reviews. So that's how I would look at that. North Colorado Dawn. Howdy, just logged on. Did you do cost segregation this year like Zuber and Matt? I did not, because I am not a real estate professional. I know Matt is not either, but his spouse is. And I don't care if taxes gave me $5 billion. That is not worth having a spouse. But I did not use cost segregation. Keith, explain subject to. So you're basically taking over someone's mortgage. That's the simplest terms. Subject to. You're taking over the mortgage. So there are some challenges to it, because the lender has to agree at some point. And I will probably have, so I almost did subject to when I was trying to give my house away. First year as a rental owner, sorry. First year as somebody who owned a rental. It was so bad I tried to give the house away. And we were going to do subject to, where she could take over the mortgage. So there's a few steps to it. How to get the lender to agree to it. You still have to qualify for the mortgage. There's times when it makes sense, but really, literally, the simplest term is you're taking over someone's mortgage. Sometimes you can do subject to, where you also say, hey, I'm going to give you $5,000 or $10,000 to move, but I'm going to take over your mortgage. Sometimes you're just saying, look, I'm going to take over exactly what the mortgage is. So each one would be structured different based on what's left on that mortgage. But that's what subject to is in simplest terms. Rob, thanks, Dion. Got a jet. Have a good night. Ciao. Tom, howdy. Jester, I'd recommend asking him whether the Zuber discount is still active, though not sure when that discount. It was like 90% or something. Yeah, I should have asked. I paid a little over $50 with tax for his house hacking course, pure gold. So one good review. Good. Good evening, Tom. Wolfmaster82 again. Need to be able to count more than one like. Nice. Javier. Howdy, Javier. Need to be able. Oh no. Hello, Dion. I'm still waiting for one rental at a time. Audible. So am I. I had like a month where I lost my voice. My one critique, and I told Mike this when I said I was going to do a video reviewing his book. My one critique was the voice that they used. Amazon used like a robot voice. And I'm not saying my voice is better than a robot voice, but I've offered to narrate the book 15 Conversations with Real Estate Millionaires. And then I lost my voice for a full month straight. So got my voice back now, so it should be happening soon. North Colorado Dawn. My mom gave me her manufactured home 3 years ago, and the taxes go up every year. The home is not deductible because I do not charge her rent. And I'm seeing mobile homes in the state that I live in appreciate the same as stick builds. They're selling a 3-bedroom house is $300 to $350. $300,000 to $350,000, and outside of the municipalities, way outside the cities. So is a mobile home, but it's the parks that the cities are against. REI Stoners, we will be up there Monday, packing and cleaning now while listening. Want to create less work for the housekeeper and hopefully get your deposit back. Good luck. Nice. And you're coming up here to rain. And as much as people say, it rains in Washington, I hate it so much. I was just in Idaho, and it's a frozen block of ice. Like, I took pictures of frozen waterfalls. In Washington, anytime we have rain, it means the temperature is generally going to be above 40 or 50. So rain makes things wet, but it also makes things warm here. Yes, somebody that lives outside of California called 40 or 50 warm. Javier. One more is better, a cheap handyman, cash, or a handyman that gives receipts. So if you're paying cash, that means they're not filing their taxes, which means, are they insured? Do they have a business license? You're liable for what a handyman does on your property. I would want to make sure I was working with a professional, even though handyman means basically, they're just handy, right? I still want it to be a business, and I want them filing taxes on it. So my 2 handymen that I work with, they charge tax. It's above the table. Earlier, I said that prison is the ultimate house hack. It's still not in my actual retirement plans, but that's what you're doing when you pay cash. Is you're generally setting it up for somebody else to be easier to cheat on their taxes. And then there's another porn link. North Colorado Dawn. I saw that video and I was telling Richard Fain not to sell his house, that he was doing it all wrong. I didn't say you're doing it all wrong. I said, I think you're making a huge mistake in his chat. I do watch his stuff. It's good, but no. The last few videos have been a bit out there. Price and Pride. Howdy. When you use Thumbtack for a big project, do you still have them sign a proper contract with detailed, what is that, schedule of work and payment schedule, etc.? Exactly the same. It's just a contractor. You just found them off of Thumbtack. Nothing else is different. I still got an estimate. I want an estimate in writing because depending on your local laws, a service provider can only charge more than 10% of their written estimate without getting written approval. So if they start a project and material cost changes or something happens and they come back and they say, hey, actually, it's going to be another $5,000. Well, if you didn't put that in writing and it's more than 10% of the size of the thing and you have it in writing, you have a better leg to stand on. You're generally going to pay the higher price anyways, but I like everything to be in writing. Timeline, and then I can write on there, this is when your tip will be, this is how much the tip will be, this is the timeline for the tip, depending on the size of the deal. That can help maintain the speed too. But yeah, I always like to get everything in writing, even from Thumbtack. The last thing, it's been a minute since I've used Thumbtack. I used it recently for a garage door. I get an email with the job breakdown, the chronology, the timeline, the cost. And the one before that was a fence, and the same thing. 3 fence contract or offers came in before I picked one. So I have not done a rehab. If there's some extra step you take when you're doing a rehab, I'm not doing that with Thumbtack. I do small things like garage door, add a fence. Yep. North Dakota Dawn. When I was building homes, I used a penalty of $200 per day for every day the contractor was late. The contractor could probably get away with that. In a time right now when there is so much work, there's so much demand, handymen are in scarce supply, contractors are scarce. I talked to 4 different companies. The 5th one never answered me to get the quote for the garage door. And time was also a part of it. How long is it going to take them to get the parts and do the work? And 2 or 3 of them were 2 or 3 weeks out. And the other one was like, we'll be there Sunday night to get everything delivered, and Monday we'll have it all done. So time was actually made them as attractive as a lower price. In Colorado, I have seen that mobile homes go for the same as stick built. Okay, it's exactly same here. Tom, Chester, more questions here. We are running out. What was your profession? Scope of work. Yeah, okay, yeah, there you go. Size of work, scope of work, something like that. Chester, actually, funny enough, Dion, does your CPA discuss tax planning with you based on your goals for the year? No, he would if I reached out, but I'm not buying in order to get the tax benefits. I buy or invest and then take advantage of the tax benefits. If it came to the point where I was deciding to pay off mortgages or continue investing or sell product or sell assets or do any of those larger decisions that aren't buying one rental at a time, save up the down payment, find the next great deal, buy the thing. If there was some change to my strategy, then I would sit with him and ask what was the best route for me and what maybe not the best route because they're not a mentor. What are the implications if I sell, if I 1031 sell, if I cash out refinance, all of those things where it comes to numbers, math, and how it impacts taxes, then I'm going to sit and ask that. But right now, my strategy is very simple. Save a down payment, keep looking at the market, know the average so I can recognize the good deals, buy the next one that pops up. Or make offers on the next 20 good ones that pop up and get outbid 24 times. Chester Williams is a hybrid corporate budget financial analyst. Nice. Tom, Dion, in the beginning, how much contact did you have with your CPA? Did you ask often? I think I talked to him twice in the first year I used him. It doesn't take much contact. Most everything is handled through email or in their portal, and mine uses Licio. So they will get a message that's saying we need these documents. Put it in there. I think in the very beginning I had a phone call and I asked questions about. I had a single family house that had a mortgage. I was saving for 2 years and I was about to buy a duplex, and I asked my CPA some real estate strategy advice. And I said it earlier, Lance, I love you. You make me a lot of money. But when it comes to investing in real estate, professional term here, freaking clueless. No idea how it works. No idea that you can make money by having debt. No idea that just CPAs, he is not an investor. He runs a business, a very successful business, so much so that he doesn't even need more customers. He's got it figured out. But I don't want to take rental advice from him, because when I asked him those questions in the beginning, I thought, wow, this person really needs a Dion Talk. And this channel didn't exist back then. I never took the time. He's doing his own thing. But I have done my own work a couple times and looked at my tax returns and what I thought I would get. I haven't gone out and hired somebody else to do like a comparison yet. I probably should someday. But I know he's doing what I need, right? Because like I said, 6 figures in profit, never paid rental income tax, but would not go to him for investing advice. Tax strategy all day long. Investing advice, not so much. Lumberjack landlord. I fired my coach because I couldn't get regular meetings for planning. There you go. I don't think anybody's going to coach you as well as you do. And if a coach was going to cost a couple $1,000s, you're better off throwing a couple $1,000s at a bad deal and losing it. The knowledge you'll walk away from is better than I think you're going to get from most coaches, because no coach has your starting position, your assets, your goals. And while they can probably try to put themselves in your position, it's nothing like you knowing what you want and then just figuring out who can show you what it takes to get there, not who's going to show you everything about it. So, Tom, Chester, that makes sense now. Chester, I realized all the fun is on finance side of the house. Accounting is a bit more predictable, but a bit more boring. And then Lumberjack, I fired your CPA because you couldn't get regular meetings for planning. Fair enough. It's probably the COVID making you not able to type. COVID. Lumberjack, how beneficial has tax planning been for you when it happened? So we'll see what that answer is here. Larry, do you know if LVP flooring with tongue and groove is expensed rather than depreciated, since it's not really nailed down or considered permanent by IRS rules? I don't know. I do LVP in every rental when I buy it, or if I have a tenant flip, I get rid of carpet, put in LVP, and it is on my spreadsheet, and in the notes it says flooring and flooring materials and installation cost. So it's all broken down, and then the CPA knows whether that's scheduled or amortized or whatever type of depreciation. That's why I pay a professional, so I don't have to know that. So that's one for the Google, I think. I know that I've benefited from it. I just don't know the way that I benefited from it. Tom, speaking of contractors, I came across my state's website location where all businesses are registered and can sort variously, such as city. Another good one to do is to figure out how your state shows licensure and insurance. If you hire a roofing company, some roofing companies will get general contractor insurance, which does not cover slip fall from an elevated position. So it's much cheaper. Roofing insurance is one of the most expensive insurances that contractors get. So they will save a lot of money by getting a different type of insurance. And if somebody slips and falls off of your roof on your property, your insurance comes into play. any fall from a roof can easily outweigh the $300,000 slip or the injury coverage that a lot of properties have. So verifying not only does your contractor have a license to do the type of work you're looking at, but does their insurance state that they're covered for what you're having done. States have that listed out, and the contractors, if you don't know it, you can actually ask your contractor, hey, what state website lists where your insurance is? And if they hem and haw and don't know and don't tell you, you need a new contractor. RAI Stoners, is BiggerPockets a good place to find a CPA? It's probably got a lot of CPAs in there to choose from and to look for. You coming up here to Washington, find the local REI meetups, ask the other investors who they use, and see if they're looking for business, and ask them what they think of them. I know BiggerPockets is a good way to connect with lenders and agents. I'm pretty sure tax professionals is probably like a subclass that they've got. I should probably look and know that. I would start there for sure. Lumberjack Landlord, Chester, not sure yet. I got fed up and just fired him. So no real use there. Chester says that makes sense. Matt has mush brain from the COVIDs. North Colorado Dawn. Lumberjack, I'm going to email you and Dion for your opinion on one of my properties that just became vacant. Sure, happy to take a look. I know what I would do in my market. I don't know your market. We have only been going for less than 2 hours, and it looks like we are out of questions. So if I was on Matt's channel, I would just say, let me entertain everybody with a ballad. But I'm a better dancer than I'm a singer. So we'll skip that. I'm going to give just a few more minutes to see if anybody has questions that we can come up with. This is your chance to pick the brain of somebody who made work optional. And it can be on any subject. Doesn't have to be on taxes. Do you recommend to do driveway before selling? What do you do to a driveway? What does doing a driveway mean to you? You're going to pave it to the road. I don't know that the return on that would justify it. That might also change based on when you want to sell. If you want to sell a house currently with the demand being so high that the supply is not satisfying it, I wouldn't do anything. I would just list it and let somebody come and pay way too much for the property because there's just not enough options out there for them. But I'll wait and see what you mean by, what do you mean by do the driveway? I'll let you answer that, Javier. What do you mean by do the driveway? And then I'll tell you what I think. Larry, are you able to estimate how much actual time, weekly or monthly, the three amigos spend on YouTube University uploads? If it's just the three amigos, I could probably do the math pretty easy. If you talk about Michael Zuber outside of the three amigos, I mean, he does 5 or 6 videos pretty much every day. I know Matt and I like to do around a 3-hour live stream. Next week, mine will only be an hour and a half because the local Tacoma 5 meetup happens on a Tuesday. So next week will be a bit shorter. I'll do the math. This Thursday during the Three Amigos, I should have quantified what we actually put out every week. And then, new driveway, concrete from Javier. It depends on your area. In my area, it wouldn't add any value to the property. Nobody's going to pay more because you have a paved or cement driveway. If you have broken driveway, I'd get it repaired before selling. And there's ways to repair that without adding, without tearing out the whole thing and putting in a new one. And if you were at a time where there was a ton of supply and you were trying to be more attractive than other properties, maybe. But there are things that you can do to add value to a property that are probably a lot less time and money intensive than driveways. People buy based on bedroom count. So whatever you can do to add a bedroom. People buy based on washer dryer hookups being inside the unit. People buy based on paint, more than a driveway, paint on curb appeal look, that kind of stuff. If you actually Google, on YouTube or YouTube look up, there are some videos on things you can, the simplest things to add value to a property and before selling. I don't think I've ever seen driveway listed out as one of the best options. Darkest Dreams 21. Howdy. Late to the party. Did you get to discuss how you depreciate a property over 27.5 years? The steps you take. Also, do you and Lumberjack have the same beard insurance? Now, I don't have the same beard insurance. I don't have the same beard. So it is depreciated over 27.5 years. I did talk about that. That's for residential loans, so 4 units or less. Commercial loans, 5 units or more. I've seen two statistics. One said that it's 33 years for commercial. One said it's 39. So we're going to have to find out what that is. It is assumed by the IRS that you took the full amount of depreciation. So there is no real benefit in not using your depreciation, because when you go to sell, there's going to be full depreciation recapture, whether you took it on your tax returns or not. That's advice from like 3 different CPAs that I've talked to. Well, tax professional and 2 CPAs. So what else with depreciation? Some lenders will take depreciation out of the equation when they're figuring out your lendability. So be more careful with write-offs on showing a loss than depreciation, but talk to your lenders first to make sure that they are the ones that do it that way. What else is there with depreciation? I think that one, there was a bit more to it. I think we covered all of that though. Keith, conundrum, Social Security, retirement limits just clocked you on taxes. Yeah, there's a certain age bracket. What is it, 61 to 64 or something, where you can only earn so much money from any kind of job, and rental income is considered earned income, even though it's taxed differently because you get to use write-offs and depreciation that you couldn't use against your W-2 job. There are some years where those taxes will hit you. I've got several employees at my company because it's a truck driving school. So our instructors range from 22 to 72 as far as age bracket of instructors. And we have some that work in that. I can only make $15,000 this year. If I make more than that, I get like I'm basically double taxed. So we work with them when we can. Javier, new driveway concrete. Larry, maybe Lumberjack Matt can also answer. Sure. Million. Howdy. If you try to increase income or decrease debt to income ratio, do you not claim repair and paint expenses and pay tax? So that's what I was saying, is sometimes when you want to look more bankable, you cannot claim write-offs on your taxes. Doesn't really do you any good not to use your depreciation, but you can say, you can't claim a write-off you didn't have, but you don't have to claim a write-off that you did have. So yes, you can do that. Always ask your tax pro, because there's more to it than just rentals. I'm talking from an investor who buys rental properties who's trying to look lendable on that. If you're running a business and you're not showing expenses so that you can get a small business loan, that's a totally different answer. And don't play in the gray areas. Put you in the gray stripes. Con, howdy. When you have other investor, can one be loan and other be title? When you have other investor, can one be loan and one be on title? That is a good question. I honestly don't know. I'm going to have to take a note of that and find out. Matt could probably tell you without even thinking. There. I know you can put people on the title who aren't on the loan, but the person with the loan has to be on the title. So it's not that you could, I'm pretty sure, I don't think you could just reverse it and not have them overlap, but you can have, yeah. God, that's gonna take some research to answer that question with any like sense of accuracy. Mark, howdy. If I have a seller finance loan of $19,000 and a conventional loan for 12 at 4.25, how would you go about paying off which loan first if it was me? So one's at 19 and one's at 12. What's the percentage on the 19,000? I don't know that I would pay off either faster than the other, but it depends on your goals. My goal really isn't to pay off mortgages. There might come a time where it makes more sense for me to pay off a mortgage. But currently I'm trying to add mortgages, and I don't personally believe in adding extra to a mortgage when interest rates are, in the 4.25 range. If you had a mortgage where the interest rate is 8 to 18 or 8 to 20%, whatever that is, it made sense in the 70s and 80s to pay off a mortgage because you were basically getting a guaranteed return of whatever your interest rate was. But with interest rates where they're at, you're going to usually get a better return by taking money and buying more assets than you would focusing money to pay off an asset, especially when inflation is 7%, interest rate is 4.25. So if you were going to pay one off first, I would go for the higher interest rate if it's 19 and 12, because you're not going to see that happen really quick. So I don't think that the debt snowball would matter as much as the debt avalanche, whichever one had the higher interest rate. But personally, I wouldn't be focusing on paying off either one of those. I would pay the normal payments, let the tenants pay off that property. Dawn, howdy. Sorry to hear that Matt got sick. Just came back from the edge of life with it myself, sending you strength. Nice. Chester, I'll pose this one to both Dion and Matt. Do you guys plan on more scaling of your portfolios this year? If so, what goals do you have? I will answer for Matt. All of your properties belong to me. That is probably Matt's answer. I believe he's going to continue to scale. He's going to continue to put his capital to work. I'm still growing, adding one rental at a time. My personal goals are I am at 6 mortgages with 7 properties. I want 10 mortgages in my name. So I'm going to keep saving and buying properties. I have the goal right now of buying my next property. I want it to cost over $1 million. I want it to be a 4-plex. I want 3 bedrooms, 2 baths each unit. So it's a real specific property. If I find it great, if not, I will buy whatever best deal pops up. But that's my target goal, is I want my next property to cost more. I have explained that a few times. Let me know if you don't understand why I want my next property to cost more, and I will explain it again. So I'm adding, but I'm not recycling capital. Matt, the lumberjack landlord, and Michael Zuber have portfolios that are multiples the size of mine because they recycle capital. They have done rehabs. They have home equity line of credits, cashed out refinances to take the money and put it to work. That is not my goal. My goal is to put money into a rental property and leave it there. My goal was financial independence, now financial freedom. Financial freedom for me, I'm pretty close. I think true financial freedom for me would come with about $20,000 a month in passive or in rental profit. And that's not far off. 1 or 2 more properties. So I'm going to keep working on that. So that for 2022 definitely means adding at least 1 more property, if not 2 in this year. It depends on what I find and how much I'm able to invest. I'm still going to be sticking with 4 units or less for residential unless I can confirm with Convoy that they have a 40-year fixed rate loan for up to 29 units. If that's true, however much I can grow my down payment will determine how many units I purchase. I do like 4 units or less for a few reasons. The fixed rate debt. So this would solve that. But the second thing is the low turnover rate. In 10 years with 16 units now, I've had a total of 2 tenant turnovers. I'm about to have my 3rd in June. Tenant told me they're moving to Eastern Washington in June, so I'm going to have another unit open up. With 5 or more units, they are units in my duplexes with their own yard and their own garage. Those are homes. Even though they're touching another one, some of my tenants have been in their properties. One's been in there for 26 years. I have not owned the property that long. That's how long they've lived there. They just don't move. It's like living in a house to them. So I'll be adding more, and then I will see what Matt says when we get there. And still Chester, and what strategy would you use based on the current rising interest rate environment? Still using yield, because interest rates is one part. You have price, rate, rents. So there's three factors when it comes to figuring out the yield. There's a bunch of other factors. Cost to acquire, how that breaks down. Profit, how that breaks down, because of your expenses to get to the yield. But those are the three things that really have an impact. So as rates go up, prices and rents are also factored into it. And each market is different, so I can't say specifically what's happening everywhere. I know that about 6 months ago, I made a prediction. It's one of the few times I was right. I actually do have a crystal ball, and it is accurate 1 out of 1,000 times. So the more things I say, the more likely it is to be right someday. But I predicted that the Idaho market would have more inventory. It was the one market that I called. Most markets are going to see lower inventory because supply chain issues is making it harder to build. Rising prices and rates makes it harder for people to buy. So home buyers are buying less, investors are buying less. So the demand is there, but we're just not seeing a lot of transactions. So across the country, and I got this information from a Kris Krohn video, and then I went online and did some research, but pretty much every market across the country is down in inventory 15 to 20%. We normally have 3 million properties makes a balanced market. Demand is so high that, so the demand is taking the properties. So there's only like 860,000 listings. So we have really low supply because of the demand being so high. A bunch of people moved from California, Oregon, and Washington to Idaho because it made sense to their political beliefs. Don't care what yours are, that's what theirs are and why they moved there. Either tax increases or mask mandates or whatever it is that made them move to Idaho. Some moved to Arizona, some moved to Florida, but some moved to Idaho. And Boise was one of the fastest growing, most appreciating markets. So Idaho was a booming, bubble-like economy. And then weather hit. It's freaking cold there. I was there taking pictures of frozen waterfalls, and they had the worst snowstorm, temperature storm in 10 years. The Boise market had an increase in inventory where the country as a whole has a 15 to 20% reduction in inventory. Boise is at a 45% increase in inventory. They're not boomeranging. They're not going from California to Idaho back to California. But now they're going to Florida and Arizona, where the weather doesn't want to just kill you. So, lost where I was at in the chat. Lumberjack said, thanks for the well wishes. Karen, howdy. Would you recommend starting the real estate journey even though the deal will break even after all costs are accounted for? So a break-even deal, does that include setting aside for CapEx and maintenance, setting aside for vacancy and extra expenses that are going to happen in the future? I personally would not buy a break-even deal, even if it included that. I want to get some kind of return on my money. We are losing. The value of our money is losing out to inflation when it's sitting in the bank. But hunt for the deal that's going to have a return. Figure out what normal is in your area, what average is. If it's everybody's break even, you're looking for the one that makes 2 or 3%. If everybody can make 3 to 5%, you're looking to make 7 to 8%. Whatever is the average, you want to make better than that. You might have to adjust your strategy. In my area, I wanted to buy single-family houses. I thought I'll use an owner-occupied loan, buy a house, live there for a year, use another owner-occupied house loan and buy another one, and then rent out the first one and rinse and repeat until I have 10. But single-family houses in my area do not cash flow. They still don't. In 10 years, I've never seen one. So I switched to small multifamily cash flow here. And as demand increases, as supply is diminished, it is harder and harder to find that cash flowing deal. But that doesn't mean I'm going to buy a break-even deal. There's a couple reasons. There's a long list of reasons. I'm sorry, I said that wrong. There's a long list of reasons why I choose real estate over stocks. Some of it is the tax benefits, like this video, depreciation and write-offs and that kind of stuff. But leverage is a benefit. I can get appreciation on 4 times what I invest. And if you use leverage in stocks, it can get a margin call and you can lose everything. 30-year fixed rate debt can't be called. So that's why I go for fixed rate debt, why I don't want commercial or adjustable rate mortgages. But with real estate, if I'm getting a 10% cash on cash return, and in stocks, if I absolutely knew I was going to get a 10% cash on cash return, either way, here's why real estate is better. That's just the cash flow. 10% cash on cash return for the real estate is cash flow while you keep the asset. A 10% return on stocks you get because you sold the stocks. To get that 10% cash on cash return, you needed to sell the asset. So it wasn't an asset, it was part of your inventory. If you have, what is the term? Dividend stocks, where the stocks are paying you, and magically you could get a 10% dividend off those stocks. So now we're looking at real estate and dividend stocks where they're basically equal. Here's why I would still go with real estate. That 10% from real estate, that cash on cash return because of depreciation and write-offs is basically tax free, tax delayed, but I'm not going to pay any taxes on it. 10% from a dividend stock is going to be taxed at a normal rate. I'm gaining appreciation on 4 times what I invested. I'm gaining appreciation on what I invested unless I use margin, which can be called. Tenants are paying off the mortgage. Nobody's paying off my debt on stocks. All of the reasons that point to real estate being the one I choose over that. But that's while I'm able to get a cash on cash return. In my area, 10% is what I shoot for. So at 7%, this still makes sense because of all of those benefits, right? If my return with real estate is 0 to 3%, and I can't count on appreciation, and principal pay down might not, because those are things that we benefit from once they've happened, but we don't predict them happening in the future, right? Stocks start to look more attractive. Historically, a well-diversified stock portfolio of index funds performs at, they say, like 8% annually every year as long as you keep it for a long enough time. Then stocks look more attractive because that return on their rental is so low. So I don't know that I would invest in a break-even deal, and especially in those first 5 to 10 properties. Once you have a bunch of properties and your cash flow is more than your dream, your wish list, in a bad time, you might put money into a rental that broke even just to give it somewhere to exist. I'm not there, and I definitely don't recommend that if you're just starting out in the first few years. So maybe adjust your strategy because somebody is investing there successfully. Find out how they're doing it. Tom says, no alligator. I'm there. Larry, can you guys do a 3 Magos episode where Matt wears a cowboy hat with plain black shirt and Dion wears a plaid? I can't wear plaid. I'm allergic. I will actually die. I can't stand the idea of going out somewhere in public and saying, I am ready in case a picnic breaks out. But I could wear a costume though. I should show you the costumes that are in here. I think we're more likely to see Zuber in a Star Trek uniform than me in a plaid shirt, which is weird because I'm a Supernatural fan and they wear plaid. Chester, Lumberjack Landlord, I hadn't been able to catch your live stream for a few weeks. Definitely praying for a speedy recovery for you. Me too. I actually reached out Sunday. I was like, hey, you okay? Where you at? Hopefully you're starting to feel better. Thank you. Matt says thanks. Marcus, howdy. What's going on? Great channel. Why do you still have a 9 to 5? That is a beautiful question, which I ask myself often. I love my job. I run a truck driving school. I get to play in a semi like it's a go-kart. I get to teach people how to get a CDL to get a good local job. And the entry-level driving wage now is about $90,000 a year. So I get to take people from whatever they were doing before and put them in a job where they're making a livable wage. Local, home every night. Our company tagline is literally be home every night. We have simulators. I run a nonprofit that does job placement assistance, transportation placement services. So I get to help people get a CDL to find a job. My nonprofit gets to help people find non-driving jobs for free without charging a penny, jobs in transportation. So I love what we do. I don't like having an alarm clock. So I'm trying to build a life without an alarm. And I'm the president of the company, so I do have a vice president and campus managers, and I'm training staff to take over more of the stuff. But we are growing into another state, so it took me going there last week. I was meeting with state agencies, employers, state representatives, trying to make sure we get the lay of the land right and do the business right to help that whole economy grow, because driver shortage is impacting everywhere. We're part of the supply chain issues, and we're part of the solution. So I like what we do. That's why I still have a 9 to 5. For me, FIRE, financial independence, retire early. FI is everything. If you're not financially independent, you belong to wherever you work. I reached FI. The retire early wasn't important to me. I don't think I'm going to retire late. I'm still going to travel more. Currently I spend at least a month somewhere. I went to Colombia, then Thailand each year, and then this year, with the not able to travel because of the stupid stuff going on, took a month with my brothers, traveled all over the country, but more states than countries finally. And this year, our plan was to go to Russia. I think that plan's been changed. So I'm not sure where the next place is going to go, and I might increase from 1 month to 3 months of travel. That's why I still have a 9 to 5. If I didn't like my job, I would have quit in 2018. It is a mind-boggling amount of mental peace, like all your thoughts are trapped in a bottle, knowing that I don't have to work ever again in my life. That I work because I like what I do. And I turned this into taxes because I was talking to my CPA. Mike was talking to his CPA over the weekend. That's what this video came about. But the video was going to be how to make work optional and why. So I've kind of scripted that out. And I talk about, I still have my job, but I wanted it to be optional. And one of the main reasons why I do this channel, why I'll do the live streams, why I put about like 30 hours a week or so into this and want to help other people do this, is because I got to experience going from a really bad position of debt, single parent, not making a lot of money, to work is optional. And I can only do that once. I can only experience that once. But now I get to help other people find out how to do the same thing, and I get to experience it every time they do it. So every time somebody comes on here and Phil goes, I just got a fourplex and this is what's going on, that's a part of the story I get to experience. So that explains why I still have this job. Matt, lumberjack landlord. Con, yes, you can have a person on the loan and another on the deed, although I would never been on a loan where I wasn't on the deed. You do need the loan holder also on the deed. Yeah, that makes sense. But just because you're on the deed doesn't mean you need, but just because you're on the deed doesn't mean to be on the loan. Thank you, Matt from Con. Darkest Dreams 21. Fine. After you hit 20K a month, you can help me get approved for another credit card. Plan to use it sparingly to improve my score more. So some myths with getting a credit card to improve your score. You do not need to ever carry a balance. The goal is to make sure that you're not using more than 10%. So if you have $1,000 credit card, that one, you never go above $100 on the balance. Even if you pay it off every day, 100 is your limit. That's one of the ways that it helps. But the longer you have the card, giving you the history and always keeping your payments current. So I put everything on auto pay. I literally pay the credit card off every day, so it never carries a balance at all. But if you have somebody that says you have to have a balance on your credit card carried from 1 month to the next to show that you can pay interest or your credit score will go up, is talking from the 1990s. Credit score came out in 1989. So in the beginning, people had all kinds of myths that they would say, and they've been perpetuated, and that's not part of how the credit score system works. So, Tom. Matt and Dion, any plans to ever be an investor in other people for them in form of loans? To be a money lender? No, not for me. I don't know about Matt. So I look as the savings account grows in the bank, and I'm looking for that next deal. That is a lot of money that is losing out to inflation. So if there's $300,000 sitting in the bank as that grows to buy the next property, and we have 7% inflation, that means I just lost $21,000 worth of buying power in the next year. That's the quick, simple math. That sucks. So you would think if I could lend it out and at least get something back, I'm keeping up with inflation. But I want the money for real estate opportunities that pop up. And so I don't buy and sell notes. That's another option. So you can be the lender, you can get into the note, so you own the loan once it's already been made. I have not considered that. Just like with real estate, I have not considered storage, the BRRRR method. Really, I've thought about it. I haven't done it. Flipping, wholesaling, investing at a distance. I'm not even considering most of those because what I do works. Super simple. Save up a down payment, buy a rental property. That's it. Margaret, howdy. Talk more about this commercial fixed rate debt. No question. Just wanted to say thank you for the content. As a first-time house hacker, 4-unit, love seeing someone ahead of me on the journey. That's awesome. Congratulations. I am still currently house hacking a fourplex. When I purchased it, I was making $1,700 a month. Now it's $2,500 a month because of the binder method. It's addicting. I don't know that I ever want to go to paying for where I live again. So I'll find some form of house hacking going forward again to repeat even for the next one. So Convoy is a company that has been on Michael Zuber's channel a few times. They have a 40-year fixed rate debt loan where it's 10 years interest only and then a regular 30-year amortized loan. So I don't know that it's the best option for a home buyer. I think it's kind of a bad idea because you're not creating any equity with principal pay down, which is just a portion of creating equity. There are, appreciation it is an impact to that too. So the principal pay down is just a portion of it, but it does delay for a long time when that's going to start to happen. As an investor, I'm investing for cash flow. So I like the idea of stretching out the mortgage. I would probably consider a 1,000-year mortgage if it made the payment low enough to where I can make the cash flow, because I don't really care about how much debt I have when I die. As long as the cash flow covered everything that I needed to live to my dream level, not just my survivability level, then I don't care about the debt. That's different than a home buyer. So Convoy, and they have several videos on one rental at a time, Michael Zuber's channel, where they talk about how that loan product works. So I'm looking at refinancing a couple of duplexes into that, if I can figure out the math on it and it makes sense. I'm looking at, and they said in one of the videos that it goes up to 29 units. Not sure how their lenders picked that number, but fixed rate debt over 4 units for me has been really hard to find. So that might be something that makes me look at more than 4 units on a property. And Chester, Californians were not ready for a true winter in Idaho. Absolutely not. I wasn't either. I was thinking about buying a small multifamily there and house hacking back and forth between the 2 states, since my company has locations in both states now. That's why I was in Idaho. We put a trucking campus there. I don't think I want to do that because I don't think I'll be going there in the winter. I'll be visiting that campus in the spring, summer, and fall, but no. I am a desert rat. Grew up in Palmdale, Roseman, California, in the high desert. And it gets cold there, but not like Idaho was. Javier, what do you think about a 4-unit, 1-room, but they all have closed porches in good condition, new windows? How hard is it to convert them to extra rooms? So there's a few factors when you look at converting living space into a bedroom. First, septic or city sewer. If you're on septic, sometimes the septic system is limited to the number of rooms you can have, which really impacts you if you want to ever sell and count those living spaces as rooms. Doesn't so much impact you as a rental. The second factor is, what is the permitting like in your municipality? Some cities are quick. I've got 2 counties. If I was ever going to build in a property, it would be in Thurston County, Washington, where they're very helpful. Added a campus for a truck driving school. Took us 4 hours to get a business license. Went into the county, got a business license 4 hours later. Pierce County, 9 freaking months to get a business license. I would not want to build a shed in Pierce County, Washington. Not that I'm being very specific, but call the city planners and tell them they're the problem. So know your local rules and what your city's like and how friendly they are with permits or strict they are with permits. What does the cash flow look like if they had to stay one-room units? A value add is always a nice thing, but what does it look like if it just had to be what it is? Does it still make sense? Because there might be some reason why when you buy it where you can't convert it, especially with permitting or septic or something like that. But I've converted dens, family rooms into bedrooms. When I purchased 2 duplexes that were basically set up as 3 1.5s, and they were 2 with a den and a family room, and the other one at a wall. Already had a closet because it was a weird center wall. So it depends on the layout of the building. Tom, oh gosh, the State of Union is on. Yeah, I'm going to listen to you instead. Oh, but we might miss out. Karen took a message back to make me wonder forever now. I will lose sleep. Tester Tom, much more entertaining, right? Tom, oh yeah, I wish he could do his alternate personality during a live stream. Yeah, I need to find a way to be comfortable talking in a different voice, because I like the versus videos where I get to express, like, here's why multifamily is better than single family. And here's why single family is better than multifamily, and mean it and actually have the actual thought and mean it from that perspective. But when it sounds like this, you can't watch that video with it down, with your earbuds in while you're doing something else. You have to watch that video. So I try not to make as many of those as I used to. But if I can figure out a different voice, which I haven't really worked on, that'd be good. Damien, howdy. Hi, Dion, can you explain affordability index and where could I find that number for a specific area? Not every area has it. So in California, California Association of Realtors offers it. And it just says the affordability index is based on the average income versus the average price of the house. This is the percentage of people who can afford to buy a house. The higher the number is, Matt and Mike explain this so much better because I haven't used it in Washington State. I have not found a source to find the affordability index. The higher the number is, the more likely they are to keep an asset. The lower the number is, means less people can afford to buy it, which means prices have gone up, so they're more likely to sell. So there's a way to use it. You might locally be able to find it. I haven't found it in Washington State, but your local real estate association is probably the easiest way to find that. And so local real estate meetups will know what that association is or which one's the most effective. So that's how I would find that. Hopefully that was a good enough explanation. If we can do one on the Three Amigos. I think we did a video on my channel of the Three Amigos on the affordability index where Mike and Matt broke that down. There's a couple of things that they've done that I just haven't done, and I really like them to explain it. I haven't done a full rehab. I haven't done the BRRRR method. I haven't flipped the property. So I make videos with them because those are things that they've done. Darkest Dreams 21. Wicked smart. Definitely why I shifted from stocks to real estate. When you say that in that Boston accent, I think of Matt because I know he's got the COVID fuzz brain going on right now, but I've seen him rattle off numbers where later I back the video up to edit something in, and I'm like, it would take me a calculator, an abacus, and a 10-year-old to figure out what he just said. So, Margaret, PDI paying 10.9% yield as of today is the equivalent of your 10% cash on cash return. Not sure how appreciation would compare. Doesn't hurt to do both. Doesn't hurt to do both. This is something I like to talk about. Warren Buffett often talks about diversification, how you diversify your portfolio. Kevin O'Leary, Mr. Wonderful, is that his name? Mr. something, but that Shark Tank guy talks about no more than 20% in any one asset, in any one asset class, no more than 5% into any one asset. So they talk about that. And then there's Warren's kind of partner, Charlie Munger, who they've been friends for decades, multiple decades. And Charlie says, the last thing you want to do is diversify. And you can watch when he said it, Warren Buffett's face just kind of goes like this. He says, if you diversify, you'll never get wealthy. You can't diversify into wealth. You need to pick an asset and master it until you become wealthy. Once you're wealthy, you protect your wealth by diversifying it. But the amount of mental bandwidth it takes to master rental properties and stocks and crypto and what type of stock and what type of rental and what market and what's changing in each one, because stocks and real estate don't do this on the charts. They are actually very different. So if you could pick real estate or stocks to master it, it doesn't hurt to take a portion and put it into stocks if you're picking real estate, or a portion of real estate if you're mostly stocks. Like even if you're completely into stocks, I suggest house hacking. Reduce or eliminate your largest expense makes it easier to invest in anything. So I blended mix, but in those first few years, I recommend focusing on one and eventually putting some of it into the other asset classes, which I'm probably 5 to 10 years away from finally looking at something outside of real estate. But it doesn't hurt as long as you're not so spread out. If you chase 5 rabbits, you're going to starve. Lumberjack. For the record, Dion, I have never had a picnic, even with all my flannel. Yeah, but you've been ready. You never know. Million. If someone has a CDL permit in MD, I would just call them America, and we don't know what the states are. Montana? No. Michigan? No. What the hell's MD? Maryland? Can he take a driving class in Washington State? You have to be a resident where you're going to test to get the CDL. The state can only upgrade a license from the state that you're in. But if you came to Washington, you could establish residency, however it takes. That doesn't take like a day, whatever, to establish residency there. You can do that. There are some states that have a mutual assist agreement where if you live in Washington, you can test in Oregon. If you live in Oregon, you can test in Washington. So whatever state you're around, you could probably do that. But if you came to Washington and you were from MD, which is Maryland, hey, look at that. It was the, 6th guest to finally get down there? I hate my memory. You would have to get a new permit when you came here if you were going to do it in Washington State. Con, I am looking at buying a duplex with tenants in the deal. What are some tips? Estoppel. Security deposit transferred to me after purchase, etc. Okay, so I'm very happy to go through this, and I want to make sure I don't forget anything. So if it looks like I forgot anything, last week or the week before, this video was buying a rental before, during, and after, and I talk about all the stuff to do after and during. So if you're under contract with a duplex that has tenants in place, you definitely want to ask for an estoppel agreement. It shows you what the leases are, what the rents, that kind of stuff. I try to talk to the tenants during the inspection, the walkthrough, and ask them simple things like, if you own the place, what would you fix? Because you want them to say, well, I would put in new screens, not, I hate the way the floor tilts when I walk through that, whatever. It says you want it to be something small. The deposits are going to be handled by title. The prorated rents are going to be handled by title. Sometimes they will say, you need to bring $27,000 to closing. Here's the paper. Since this is the rents and this is the deposits and this is the whatever, you only need to bring $23,000 to closing. Or they can go, you're going to bring $27,000 to closing, and then we're going to send you a check for $4,000. Each title can do it differently, but they're going to handle deposits and prorated rents. Prorated rents means if you close on a property on the 15th, the rent from the 1st to the 15th belongs to the previous owner. 15th to the end of the month belongs to you. Title will handle that. Enjoy the gap month. When you close on your property, if you close, let's say you closed in March, you do not have a mortgage payment April 1st. Your first payment will be May 1st. If you closed April 2nd, you do not have a payment May, you have a payment June 1st. So it's always the next calendar month after the end of the current month that you're in that you're going to have your first mortgage payment. And I said always, might not be true. Every time I've ever talked to a lender or any investor ever, that's the way I've heard it was. So it's probably possible that there might be a situation where that's not the case. I've just never seen it or heard of it. You are bound by the existing leases. So you can't force changes to the lease, can't change the rents or shorten it unless you're buying it owner occupied. You, in some states, you can give a 90-day notice that you intend to occupy, and that gives the tenant that much time to move out, even if they have a longer lease. Depends on local laws, though. Deposits. Make sure you have a landlord introduction letter ready. You can reach out to me with an email if you want. I have a really basic one. I just Googled landlord introduction letter. Something that includes the sale has happened, usually reference something like the inspection or appraisal that they were there for to see, and that you don't pay your rent to the previous owner. Here's how I like to collect rent. Here's my contact info. There's something else I put in there too, which I can't remember right now. But if you email me, I'll send it to you. So those are the things that you do after closing. You're going to want to set up landlord, not contracts, landlord agreements with utilities, so that if the tenant moves out, the electricity switches to your name, so that there's power for handyman and contractors to do things while you have the ownership. I have a feeling that there was a bunch more in that video because I had taken notes and prepped for that. Buying a rental before, during, and after. So I would check that video out. It's in the first like 30 minutes of that. And then hopefully you review the binder strategy video. There's 2 on my channel. One's 5 minutes, one's 20 minutes. The 20-minute version is the one I made for the class for one rental at a time. It breaks down all the nuances of how and when to use the binder strategy on inherited tenants or tenants you have, but it would be good to review that before you did it. And hopefully you know what the binder strategy is. If you don't, it's my strategy that gets the tenants to request a rent increase. Very powerful and a good thing that helps me find my deals right off the MLS. Larry, Lumberjack, hope you get well soon. Me too. Keith, smash the like button. I would appreciate it. Javier, $200 difference each unit. Section 8, fair market, but for sure is 300. Ouch. I've used the binder strategy on the Section 8 program. Now, it depends on your county. It could be run by a state agency, the housing authority, or it could be run by a nonprofit. I did it via email. I didn't go into their office and say, hey, I'm going to show you a binder and do this. What I sent an email saying, here's a map of all the rentals in the area. Here's the comps with the same number of bedrooms. And remember, Section 8 cares about bedroom count. They don't care about pool, hot tub, garage, none of the family room, den, room count. Nothing matters but bedroom count. They rent based on bedroom count. I showed them that the area average was in the 24 to 25 range. They were telling me that 18, like 60 was the most they would pay. I showed them this. We went to 22, mutually agreed to both sides. So now I have a house rented out for 2,200 when Section 8's website and email initially to me said 18, whatever it is. I thought it was just 1,800 plus 60 for water. Yeah. So it was like 1,800. They went to 2,200 because I sent an email. You might have a housing authority or a nonprofit that says hard and fast rules, can't do nothing to help you. Sorry, no, sorry. But they need units. Provide them something that they can take to their boss and say, here's why we made this exception or adjustment, or why we need to relook at our prices, because look at all these comps you sent us for 2,500. So binder strategy works on housing authority. And Chester told me Maryland. Good. Lumberjack. Sent you affordability index for Washington. Oh, nice. Cool. I have never used it. But again, Matt and Mike's goal is to grow this machine of rentals that buys more rentals. And they've done it successfully. I'm not jealous. I'm impressed. It's not my goal. I'll look at the affordability index. I'll look at it and I'm going to study it and figure out how to, use it somehow in a video to make sense for the people who are looking for a place to buy, or if they're deciding whether they want to buy or sell properties. I plan, like a wedding, buy and hold forever until death do us part. So I haven't used it in my metrics at all. I'm going off a yield and I self-manage, so it's going to be wherever I'm located. But cool. Thanks for finding that for me, Matt. Appreciate it. Tom, what is estoppel? A fancy word that realtors use for documents that prove what the current rents are and if they're being paid. And it might have a few other details in there, but that's what I've associated it with. It just means proof in writing of the funds of what's happening in the rental now. Because when you look at an MLS listing, there's this fancier word that means made up crap of when you see the rents, they are not a prospectus. I love my memory. I literally just had the word in my brain. There's a word that says estimated rents. And in the MLS listing, it says it is buyer's responsibility to verify all of these made up numbers, which are literally made up numbers. So I wouldn't use those in your calculations, anything listed on the MLS. I wouldn't use the current existing lease to run my numbers. Area average rents, set rents. I was looking at a duplex and a tenant was paying a really good rent. During the walkthrough inspection, while talking to him, he explained to me how he didn't pay a security deposit. So they raised his rent a couple $100 every month for the first year. And then he expected his rent next year to go down a couple $100, which would not have been a great rent for the area. So even if you see it in writing, area average rents tell you what a place will rent for. John, Texas. Howdy. I've got to put my Texas hat on. You mentioned on the Three Amigos that you have a strategy regardless of whether rates go up or down. Can you share those strategies? Thanks. Yes. So if rates go down, I'm going to refinance properties to a better rate if they go down enough. I'm going to use the calculation of lower rates because price, rates, rents tell me what my yield's going to be, with a few other things factored in there. So if rates go down, I'm going to be trying to buy before prices go up to adjust for the lower payment options that homebuyers have and investors can get better yield. So I'm trying to be at the front of that curve. That's why you want to watch price, rate, and rents every single day. Know your market. If rates go up, I'm not going to refinance. I don't do it myself. I'd be less likely to take money out to put it to work because it would be harder to get a return that was strong enough to justify the added expense of the higher rate on the money I pulled out. Either way, I'm looking for properties to purchase that get the yield I want, and that yield might go up or down. I don't have a yield goal of 10% cash on cash because that's what makes the most sense for me. If average in my area was 7 or 8, I shoot for 10s. If it dropped to 5, I would shoot for 7 or 8s. Like I said earlier, if it drops to 0, I might not shoot for a 3 or a 4 because I might start to look at a different asset class if it was that low, or switch strategies from small multifamily to storage, or from small multifamily to RV pads, or whatever's going to get me the return I'm looking for that makes sense in that market. I'm not really there, but if rates went high enough to where I couldn't find the yield and I couldn't find an asset class to invest in the beginning, house hacking is much more important. At the stage where I'm at now, it doesn't make sense. So don't think this is advice or what I'm going to do. It almost makes sense to start paying off mortgages. Kris Krohn said it really well. He said, once you have income from your rental properties or your passive income to your dream level, above that doesn't really matter. Now you might start focusing on stability, which is paying off mortgages or that kind of stuff. I'm not there yet, but that could be an option. So I kind of have that stretched out plan of when I would refinance, when I wouldn't refinance, when I'm going to try to get in before the prices adjust to kill the yield, or when I might look at different asset classes. So that's what I mean by having a plan for either. Kind of like running a truck driving school. You have politicians that look at the world this way and politicians that look at the world this way. One means more funding for training and another means better business tax benefits. So you have a plan for it. It doesn't matter who gets voted into office if you're running a business. You might prefer one or the other, so you actually vote because that's the system we're in, but have a plan for either outcome. Real estate, same way. Con, I did a cash out refinance today, closing day. Awesome. Congratulations. March 1st. And my first payment is April 1st. Really? So they told me that it would be May 1st, which I found out is incorrect. So lenders are not all made the same. That's so weird. So you closed March. So I wonder if they set up all the closing documents for yesterday. Huh. That's a new one on me. But you timed it just right. But they even told you it would be May 1st, and then last minute it changed to April 1st. That is weird. Martin. Howdy. I've heard you say that you don't like to show a big loss on your rental income when doing your taxes so you can be bankable. Do you know if a depreciation loss also affects it? So check with your lenders. Each lender might do it a little bit differently. And at the beginning of this video, I kind of covered that on taxes, where it is going to be assumed by the IRS that you took all depreciation that you could anyways. Write-offs, you have some control. Just because you purchase something doesn't mean you have to use it as a write-off. You can, but you don't have to. Most lenders, the lenders I've talked to, said when we're figuring out your bankability, depreciation is taken out of the equation. But check, because it's possible that some lenders leave it in there and they want to see. So what I do is I use all of the depreciation, and then I use enough write-offs, and I tell my CPA I want my write-offs to bring me down to close to zero. Maybe I lose $1,000 or $2,000. I don't want to carry forward a big loss because I still want to be bankable. So if they take out the depreciation, I still want to look bankable. The lenders that I work with take it out. So it's possible that you find some that don't. Ask them. All lenders aren't made the same. Chester, Tom. Promissory estoppel is basically where someone relies on a promise you made to their detriment. Illegal business term. Pro forma. Pro forma. That's the made up word. It sounds like a made up word. It's when they put in there, oh, we think the rents are like $2,500 a month. And then you look on apartments.com and everything's for $1,200 a month. They're legally protected. It says in there, these don't matter. Check and verify yourself. Thanks, Chester. Only in writing promise. So the estoppel that I've seen when it comes to real estate, there might be like a technical legal term that they named, but in real estate, it's usually here's the leases and a letter saying this is what's being paid. So yeah, in writing. But emails are admissible in court in most places, so an email might be in writing. Kind of rusty on business law. I believe both written and spoken, but spoken may be more difficult to prove in court. Hence the phrase, get it in writing. Yep. Matt, the lumberjack landlord. The case in our state is you can't go more than 45 days after closing for your first payment to be due. I close on the 16th. That gets me 1.5 months of rent with no mortgage. Okay, so there's a different limit than what I've experienced because mine was more. I closed on January 6th, didn't have a payment until March 1st. And then May 5th, June. It was so far every time I've gotten that month free, but you're literally on the first of the month to the next month. So weird. Huh. And I think we are almost out of questions. There's a couple of people came late to the game. If you have any questions, the purpose of this video was to cover taxes and rentals and you being squeezed in the middle. And actually, I explained why taxes are one of the top reasons why I invest in real estate. Chester, thank you. We only went 2 hours and 47 minutes this time. Disappointed. We need more to go. Like I said, I'll just start juggling. I would juggle this if I didn't think I would break the floor because I would break the floor. I did that in one of my videos in the early on when I was recording a video. I think I put it in the bloopers kind of at the end too. Dropped it in there. That's a new piece of hardwood floor there. I don't think I can entertain you guys even with a ballad for 11 minutes. I can grab the Ouija board, find out what people have to say. Just giving you guys a few more minutes in case people have any more questions. Or suggestions for topics for videos. I am always open to those. Thank you, Don, for hanging out. Javier, what do I think about? I think you missed the second half of the question. Con, hope more houses is coming up in the market. Yeah. Michael Zuber said it really well the other day. He had a video that came out that said, we don't have a supply issue. I've said it. He's said it. A bunch of content creators, the news, the media, everybody has said we have a supply issue. It takes 3 million properties on the listing to be a balanced market. We're at 860,000. We just don't have enough supply. And he really clarified, we have a demand issue because there were more transactions done last year than in the years where we had a balanced market. So there is enough inventory. It's just selling so fast because of demand, over market asking, fast offers, waiving contingencies. The transactions were happening. We just don't have enough for it to seem like a competitive market that we can compete in. Now is the time to be a seller, not a buyer. And if you're an agent, now is the time to work with sellers, not buyers. So yeah, being a landlord in rental in a blue state versus a red state is a good idea for a video, and I've thought about it. But there's this thing on YouTube where if somebody gets just the idea that you're on one side or the other, it's usually the death of your channel. Demonetization, they stop promoting it. An example is, and what is his name? There is a YouTube content creator. He made his channel huge. Where is it? It's gonna, hopefully the sound is off. Awaken with JP. You've probably seen some of his videos. To get his channel big, he was very far left. Now that his channel is big, he's very far right. That's one way to do it. So I've been really hesitant to make a video that's either right or left. And I've talked a couple times about most investors say they want to be in red states, which would make me sound like I want to be on the right side. That's the right. But Grant Cardone was on BiggerPockets twice, and in his second interview, he talked about the reasons why he prefers blue states. Like there's actually reasons that made sense, and it was the first time I ever heard anybody say them. So I think if I can find a way to literally be neutral, because there are benefits to both. Democrat states high rent and Republican states low rent. See, so to be neutral, in the last 2 years, a lot of people moved from blue states to red states, increasing the demand. So we're getting higher rents in red states. But in blue states, they limit building. Permits are harder. Restrictions are harder to add things. So appreciation happens more in blue states because you have more limited supply than the limited supply we have everywhere else. So there's a reason for both. And not everybody was moving from blue states to red states because it made sense. A lot of people were looking at, I can live in this blue state where I have a state income tax or higher property values, but now I can work from home because a pandemic made that a bigger option than before. I can homeschool my kids. Pinterest paid $89 million to break their lease in San Francisco and then gave $20,000 to everybody to move somewhere else. So it might not have been a political move to move out of blue states into red states, but it was a money-based move to move from where it's expensive to where it's less expensive, even though they're now making more based on the median income of that area. Really hard to stay neutral on that. And I don't have a dog in the horse. I have a friend who has a YouTube channel, and he used to get 60 to 70,000 views per video. His channel was killing it. And he made a video that said, I didn't want to get vaccinated, but I got vaccinated anyways because I want to travel and give whatever. And he says, so I'm vaccinated, but I don't support the mandate. His videos dropped to 1,000 views per video, if that, because the people on the right were like, oh, you got vaccinated, you suck. And people on the left were like, you didn't want to get vaccinated, you suck, or whatever the right and left version of that was. So even having an opinion where he was trying to say both sides hurt him that way. Hard one to answer. Don, every time I find a property, it always goes for over asking. I guess people do not want a good return. Or they're doing a cash on equity return. This is when I'm going to make a video. This is when it makes sense to overpay for a property. I buy a house in 2000 for $100,000. I refinance it for $150,000 because I have to pay my ex out her portion of the equity, and I still hate that. So I've paid $150,000 for a house. It's paid off. I have $150,000 into that house, and that's it. House is now worth $480,000. I could sell it, 1031 that into something else, where I'm putting 480, seller fees and everything else. I take 6% out. So let's say I only have $400,000 left. I put $400,000 into another property. I can overpay because I'm only $150,000 into my house. It's completely paid off. I paid off the mortgage. So I didn't just, borrow that or I got in with it with zero down. So if I had not paid it and just used the appreciation and principal pay down of the tenants in there, I'd still be taking $200,000 or $300,000 that technically I didn't work for. I just have it because I own the property. And I use that money to buy the next property. I can overpay for that property. And I'm getting a really good cash on cash return based on what I actually had in the first property and what I'm getting now. I'm still getting a terrible cash on equity return. But that's why people can overpay for properties. They can pay $1 million over asking if they've rolled the properties the right way. It isn't the best thing to do. They could have put the money to work better doing something else or hunted for the better deal. But when you see someone that overpays, it's usually something like that. They're taking money that they got from an asset. So their initial investment into whatever that is. If somebody bought Bitcoin when it was $2 a coin, and they bought $100,000 worth of Bitcoin, and then it went to $70,000 a coin, and they sold it all, and they have billions of dollars. And then they pay $5 million for a place on the beach that's worth $200,000. They don't care. That's the extreme. But when you put money into an asset and it appreciates so much that when you sell that asset, you have a whole bunch of money that technically really isn't yours in your mind because you only had that initial investment. You'll see people overpaying a lot. Took me a while to wrap my head around that, but I had a couple of my friends do it and explain to me why they were able to spend way more money than I would have paid for the property. And he was like, I'm 40 grand out of pocket, but I'm walking away with a $900,000 duplex from my 40 grand. I was like, oh, okay. I'd pay $600,000 for that duplex, but I get what you're saying. It's weird. Chester, gentle nudge, video coming for neighborhood classes. Oh, that's right. Oh, I need to take a note. I need to start keeping a pen next to this so I can take a note. Yep. Because I do want to break that down, but that's going to take like a week's worth of research so that I have the actual reasons that what justifies it being a neighborhood, not just what makes it work for me. Because in my area, what's Class C might not be Class C in someone else's area. Matt, the lumberjack. Javier, it's more about income tax versus no income tax. Tom, great night. Thank you. Javier, yes, I hear him in BiggerPockets. Yep. Javier, I'm from Illinois and love my high rents. My loans are $550 and my rents are $1K, 3 rooms and still going up. Yeah, my rents in Washington I can't keep my mind around what is happening to the rents here. Pretty much everywhere. I mean, except I would guess in the next 6 months, Idaho. But we'll see. Keith, you haven't got 24 hours in our market to make the deal, be ready, set, and go. Yeah, no, and 24 hours would be under contract within 24 hours. I think you usually have 2 to 3 hours at most to have an offer, an actual official docu-signed offer made to even be considered. MJ J. Noel, howdy, thank you. Javier, lumberjack landlord, thanks. Dawn, playing with the house's money. Exactly. That's a great reference. I could have summed up 12 minutes into 30 seconds. Where was I doing? Sorry. Lumberjack landlord, Javier, blue and red doesn't matter. I'm in the red governor, blue Senate and Congress. I get $3K for 4-bed in duplexes, and that's in 525 duplex. Javier, think I was just confused because I hear the guy in BiggerPockets and got me thinking. Yeah, so somebody is investing successfully everywhere. Have a strategy that works there. Some people say, I don't like places that aren't landlord friendly. Well, what does that mean to you? Does it mean evictions are hard, or does it mean the insanity of in Seattle where if you want to do more than a 10% rent increase, you have to give 6 months notice, and if the tenant doesn't like it, you have to pay for them to move? Like, I don't know if that's red or blue. That's just crazy. Chester, lumberjack landlord, same. Red governor, blue house, Senate. Here. So Michael Zuber said this one time really well. The best thing is kind of when you have a divided government. You red leadership, blue, House, Senate, whatever it is, because not a lot changes. You have stability for the market. If an area goes all blue or all red, a whole bunch of changes can happen because they control enough of it, right? So that creates instability, which is not good for almost all assets. Tiffany, the free month when you first buy a rental property is because mortgage interest is paid in arrears. When you sell, you pay off is typically the balance on your statement plus one more month of interest. Nice. So end of loan problem or refinance problem or sale problem. Yep. North Colorado Dawn, use your phone notepad for notes. I should do that. Matt, the lumberjack landlord, agrees that I am right. Strategy depends on states, county, things that change. I mean, the strategy for Arizona and Florida in the last 2 years was very different than it was 5 years ago in those same two states. You could literally watch the trends. Where was population going? Where was the U-Haul trucks going? So area, politics, trends, study your market, know average so you can recognize great. And it changes. Area rents in my area changed good deals. And I have a video on my channel called, it's not a title, it's like Who Got the Better Deal? I bought a duplex for $298,000 and my friend bought a duplex 6 properties away for $555,000. Her deal is better than mine. I bought mine in 2018. Interest rates were 6%. Rents were like $1,200. Her interest rate was 2.7 something percent. So like less than 3%. Rents are over 22.30 aside. So basically half the rents for twice, or half the interest for twice the rents. Hers, even though she paid hundreds of thousands of dollars more, was a better deal. She wouldn't have known that. I wouldn't have known that. I wouldn't have known to suggest for her to buy it. I even told her it's such a good deal. You're going to buy it. And if you don't like it, and if you decide to get out of real estate, I'll buy it from exactly what you paid for it. So she had good confidence going into this deal. But if we weren't studying the market every day, I would have looked at that and I would have said, wow, I paid $298. They want $555. That's crazy. Let's look for something else. But I saw what happened with rates. I saw what happened with rents because it's 3 factors: price, rates, rents. That tells you if it's a good deal or not. Chester, Dion, exactly. That's one thing I can say has happened between governor and legislature. Not much law. Nice. Cool. Well, I want to thank everybody for hanging out with us tonight. I appreciate it. If you're interested in my thoughts on taxes, I tried to sum it up in the first 10 minutes. So if you go to the first 35 minutes, you'll hear me talking about taxes. And I really want to say thanks for hanging out for a nice, short live stream. Just like I said at the beginning of this video, we would just do it for a bit. You deleted your comment. It was political. I appreciate you doing that because that's the thing. So you can mess with me going forward. I pretty much read every comment, even the one where somebody asked me if I was gay. I don't care. I'll read it. I had an answer too, but you can mess with me. Put in a comment. I'll probably read it because if you're like me, I have YouTube Premium. I like to put on the earbuds, put on a YouTube channel, and then put the phone down. It's closed away, and I can go do whatever while I'm listening. So sometimes when somebody comes to one of my live streams, they're like, oh, this guy's reading every comment. Why is he reading every comment? I can see the comments while we're going. Well, it's because in the future, in future land, somebody's going to be watching this by listening to it. And that's why I do that. So I think we're going to call it there for the night. I want to thank everybody for hanging out. Until my next video, thanks for coming to my Dion Talk.